Yes, good morning everyone. Let's begin with next chapter, that is portfolio management. Very important topic. Okay, it is applicable in two different chapters as well. As we go further, we'll see asset pricing also is one more chapter. There also this will be applicable. So we'll discuss about portfolio management. What is portfolio first of all? Then we will see the management part of it. What is portfolio? What is portfolio? Like for example, if there is one person and this fellow has 1 lakh rupees with him and he wants to invest. Let's say he invests this full 1 lakh in Infosys shares and Infosys shares goes down. Okay, then he'll have a huge risk, that is money is going to go down. So instead of that, what he can do, he can put 30,000 rupees in Infosys shares. Then he can put 20,000 rupees in Reliance, and then he can put 50,000 rupees in gold. Can you see what he has done? He has distributed his investment, and this distributed investment is called as portfolio. So he has created a portfolio of his investment. Instead of putting all your fruits into one basket, he has put his fruits into multiple baskets. So if at all, gold might go up, okay, Reliance might go up and Infosys might go down, it will compensate and he will get an overall return. Clear? Now he's like, sir, if he could have put completely into gold only, but if gold goes down, complete risk also is on one topic only, on one item only. So therefore, portfolio management. Now you have to understand how to calculate the risk of the portfolio, and we also have to understand how to calculate the return of the portfolio. Now, first thing that we are going to discuss over here is single security. What is single security? You have one security, you have to calculate the risk of that security and also you have to calculate the return of that security. Now, if I am talking about single security, first we will calculate return. Okay, single security can give you single period return or it can give you multiple period return also. If you are calculating for single period, okay, that time return percentage will be D1. What is D1? Dividend at the end of the year. Now see, if I am holding one single security, what return can I get? What return can I get from this? Every year I'll get dividend. Okay, or I'm holding it only for 1 year. I can get dividend and I can get price appreciation. So getting the dividend is a benefit for me, and the price of that share going up also is a benefit for me, because if I sell it, that time I'll get capital gain. Clear? So dividend plus P1 minus P0 divided by P0. What is P1 minus P0? P1 is price at the end of the year and P0 is price at the beginning of the year. Now whole thing divided by what? Price at the beginning of the year, because you are trying to see what is the return. So basically you are telling from the price that was there at the beginning of the year, how much return you have made on that particular amount. So if I put 100 rupees at the starting of the year, or if the value was 100 rupees at the starting of the year, from 100 rupees how much benefit we have derived. Okay, so D1 plus P1 minus P0 divided by P0. You need to know this particular formula. Clear? Now D1 is dividend at the end of the year and P1 is price at the end of the year. Note, this is a very important note. Now see, I had shares. Okay, let's say I had 100 shares. Starting also I had 100 shares. Ending also I had 100 shares. Now, starting I had 100 shares. Now, if I calculate per share also, or if I calculate for total number of shares also, I should get the same return. So, for example, you see, I had 100 shares, okay, and the price at the beginning of the year was 100 rupees, and price at the end of the year has become 110 rupees. And the dividend that is there is, let's say, 5 rupees. So, now what happens? If I calculate D1 plus P1 minus P0, the whole thing divided by P0. So 15 divided by 100, you should get 15%. Correct? 15%. Now imagine I don't calculate like this. I calculate for total shares. So I'll tell that I have 100 shares into 5 rupees dividend, plus I have 100 shares into price at the end of the year is 110, minus I have 100 shares and price of the beginning of the year was 100 rupees, whole thing divided by 100 shares into 100 rupees, what would I get? I would still get 15% only. It doesn't matter at all because this 100, 100, 100, 100 everywhere will get cancelled off with each other. Ultimately, I'll get 15% only. But certain corporate events can happen. The corporate events. What are these corporate events? Corporate events are basically bonus shares are given or there might be share split. What is share split? 10 rupee share got split into 1 rupee shares. Okay, or 100 rupee share got split into 10 rupee shares. So now, if in that case, your starting of the year number was different, ending of the year number is different. So if number of shares have changed between year beginning and year end due to corporate events such as bonus, stock split, etc., then use total data in the formula for return percentage. Don't use per share data. So what you're going to use? You're going to use the total data. You're not going to use the per share data because per share data will not give you information properly. Because per share data is per share. But starting of the year, I had 10,000 shares. End of the year, I have 15,000 shares. So now that common cancellation won't happen in this formula. So you will have to calculate for total. Clear? Let's see some example for this. Now see, if I talk about single period return and if I tell you 1/1/2025, the price was 30. 1/1/2025 means starting of the year. So it is P0. 31st of December 2025, price has become 40. That means this is P1. This is P1. Dividend paid is 5 rupees. So if I have to calculate single period return, D1 plus P1 minus P0 divided by P0. You're getting a return of 50%. Correct? You're getting a dividend of 50%. Now, if interim dividend of rupees 3 is paid during the year, what is interim dividend? What is interim dividend? Interim dividend is dividend paid during the year. Usually what happens is dividend, if my year gets over on 31st of March, then my accounts will be finalized and closed and audit and all will be done. And then I will hold one AGM. Somewhere around September, I will hold one AGM. In that AGM, what we will do is we'll pay the dividend or we'll declare the dividend for the previous year end. Clear? That is called as final dividend. That is the common dividend that we see. Interim dividend means dividend paid during the year for the year. Now first quarter got over or second quarter got over. That time I saw that I'm actually making more profit than what I expected. So why wait till end of the year? Now only I can just I can give the shareholders the dividend. That is called as interim dividend. For you, when you're calculating return, you get final dividend. That also comes into your pocket. Or you're getting interim dividend, that also comes into your pocket. So it doesn't matter whether it is interim dividend or final dividend. If you get dividend of 3 paid during the year, take that in the numerator. Can you see 5 plus 3? You got 8 rupees now and share price has gone from 30 to 40. So you have 10 rupees here divided by 30. You get a return of 60%. Is this part clear? Okay. Now this is your single period return. Now one more thing we will see. If D0 is given in the question, this we have already studied in our dividend growth model. D0 is given in the question and growth rate is given 10%. We don't want D0. If they tell in the question, dividend paid during the year, company just paid dividend, company just declared dividend. That means they're talking about what? Today. They're talking about today. We want dividend at the end of the year. So if they tell expected dividend or estimated dividend, that time we are getting the dividend at the end of the year. So therefore, D0, okay, if it is given and growth rate in dividend is given. So in our formula, we will take the D1. We'll take the D1. So 5 plus 10%, you will get 5.5. Then plus 3 plus 40 minus 30 divided by 30, you will get 61.67%. Clear? So 3 situations we saw. Normally, if there is single period return when we are discussing, normally if they give the dividend, you calculate the return. Okay, if interim dividend is given, then you add that also to your numerator. And if there is a dividend D0 is given, then what you will do, you will calculate D1 and then you will get the return. Clear till here? Now, this is the corporate event which we were discussing. Corporate event, if bonus shares are issued during the year, okay, that means number of shares on 1/1/2025 was 10,000 shares. Bonus shares that they gave is 5,000 shares. Now, if you calculate normally, like how you are doing till now, no, you will do 5 plus 40 minus 30, the whole thing divided by 30. Clear? You get 50%, but this is wrong because starting of the year, 30 rupees into 10,000 shares. So your value was different. Now it is 40 rupees into 15,000 shares. So the total value is different. Okay, so when you're calculating that, now tell me one thing. You have to understand one thing. Obviously, I will do 30 into 10,000 shares. And here I will do 40 into 15,000 shares, because end of the year I have 15,000 shares. And denominator 30 into 10,000 shares, because starting of the year I have 10,000 shares. All this is sorted. But this 5 into how many shares? 5 into how many shares? 10,000 shares or 15,000 shares? 10,000 shares, because bonus shares came this year. Dividend they're paying for the previous year. If at all it was interim dividend, then interim dividend you would have multiplied into 15,000 shares, because interim dividend they are giving for this year. Then interim dividend we would have calculated for on 15,000 shares. But final dividend is always given for the previous year. When they're giving it for the previous year, you will multiply into the shares which are there at the beginning of the year. So this is how you are going to calculate 5 rupees dividend into 10,000 shares plus 15,000 shares into 40 rupees at the end of the year, 10,000 shares into 30 rupees at the beginning of the year, divided by P0. So basically D1 plus P1 minus P0 divided by P0. Can you see the same thing is happening over there as well? Okay, only thing is you cannot calculate per share. If you calculate per share, you saw what was happening. You are getting 50%. Your return was only 50%. Obviously, your return is more, no? Because you got some free shares. When free shares are coming and falling into your pocket, obviously your return has to be higher. So you can see 116.67. That is our discussion on single period return. Clear? Now, what if it is multiple period? Now we saw single period, no? 1 year we saw. Okay, so we were easily able to calculate. Now if multiple period returns are there, what will you do? We have learned those statistics. Okay, so multiple period return, what you will do is you will take arithmetic mean, simple average. Okay, summation of all the returns divided by n. Total all the returns divided by n. Holding period return, if year 0 is 100 and year 5 is 130. If they give like this, then the holding period return is 30%. Holding period return is 30%. But what is your return per year? That you have to calculate. Clear? So now if you have a situation like this, okay, you have a situation like this. Year 0, it was 100 rupees. It became 130 rupees. Dividend and all not given only in the question. Only the price has fluctuated and it has become 130. So if investments having a different holding period, then holding period return are not comparable. Now we'll see that is a different situation. Now imagine I have 100 rupees share. Okay, that has grown and it has become 130 rupees. The share which was of 100 rupees, it has grown and become how much? 130 rupees. Now, how will you calculate the return? I know overall I have a return of 30%. Per year, what is the return? Can I just do 30% divided by 5? 30% divided by 5, sir, 66% return per year. No, you can't do that because growth happens in a compounded manner. So what you will do, you will use the formula future value is equal to present value into 1 plus r to the power of n. So therefore future value, it has grown and become 130. Present value was 100 and it was 1 plus r to the power of r, we don't know, 1 plus r to the power of 5. In 5 years it has become 130. So if you take in this particular situation, it will be 130 divided by 100. 130 divided by 100, it will be 1.3. 1.3 is equal to 1 plus r to the power of 5. Now in this case, when you are solving, what we will do? You take this to the power of 5, you bring this side, that time it becomes root 1.3 is equal to 1 plus r. 1 plus r. Now if you have to simplify it, r is equal to root 1.3. Take this 1 also that side, that time it will become minus 1. Okay, this r is fifth root of 1.3. How will you calculate this? Calculator technique. Take 1.3 in your calculator. 12 times root sign. 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11, 12. Minus 1. Okay, then into. Fifth root means in fraction it is 1 by 5. So into 1 divided by 5 plus 1. Then is equal into is equal to 12 times. So you can see that you are getting 5.39%. So the return on this stock is actually annually how much? 5.39%. If you would have done 30% divided by 5, what you would get? You would get 6%. Okay, but actually it is 5.39% compounded growth which has led to 30% of growth. If you do 5.39 into 5 years, you won't get 30%, you'll get only 26.95%, because first year's growth added on to second, third year, fourth year's growth. It's compounding. In a compounding manner, it is growing, so it's 30%. Is this clear till here? Now, to be computed as follows: holding period return divided by holding period. That is, if you have different, if investments have different holding period, then holding period return divided by, you can't compare, no. Imagine one company has holding period return of 30%, but this was only for 5 years. One more company is there which has a holding period return of 40%, but this was for 8 years. Now you can't tell, no, oh, this stock has holding period return of 40%, so I'll go and buy this stock. So to compare these two, what you will do? 30 divided by 5, 6%, and 40 divided by 8, you will get 5%. Can you see? If you would have blindly seen 40%, you would have chosen this stock. Sorry. Okay, but actually this stock has given you more return per annum. So for comparison purpose, you will always follow this. Is this clear till here? Now, next, holding period return are now comparable when you divide this. CAGR, compounded annual growth rate. Use geometric mean to compute growth rate. Geometric mean is exactly what is happening in that future value, present value formula. Now, geometric mean, how do you calculate? Geometric mean is equal to, let's say, fifth root of, then you will write 1 plus R1 into 1 plus R2, so on you will write into 1 plus R5. Clear? And minus 1 outside the root symbol. That time you will get the geometric mean. And this is exactly what happens in your future value is equal to present value into 1 plus Rn. Use this formula, you will get the same geometric mean itself. Clear? That is your discussion on return. This is the discussion on return, and we have done the discussion of what return? Only a single stock. We have not gone into portfolio at all. One stock when we have, one single security when we have, this is how you calculate return, and this is next we are going to learn how to calculate risk. Clear? Now we'll see multiple period return. We'll see an example. Imagine holding period return is 30% and holding period return is 20%. So can I directly tell, oh, 30% one I will choose? No. You have to see what is the holding period. Holding period is 5 years and here holding period is 3 years. In 3 years, this is giving you 20% and in 5 years, this is giving you 30%. So divide, you will get per year 6% over here and per year 6.67% over here. Clear? So obviously you will choose this one. One more example we'll take. Now, if I have a situation like this, year 2020, 2021, 22, 23, 24, 4 years data is given. We have dividend. Okay, dividend what is paid during that year is given. P1, P0 both are there. So now what you will do? Listen, in the question, no, they'll give you prices like this. They'll give you prices. Now we don't want price. We want the return on that price. So don't directly tell, oh, price is given, I will take the total price and take average price. No, you can't take that average price. You have to calculate return only. So every year what you will do, D1 plus P1 minus P0 divided by P0. So first year if you take your calculator, it's going to be 10. Keep using your calculator so that you are understanding the calculation. 10 plus P1 is 80, 80 minus 50. The whole thing will be divided by what? Whole thing will be divided by 50 divided by 50. Are you getting for 80% over here? Yes. Second year what you will do? 12 plus 90 minus 80 divided by 80 into 100. So are you getting 27.5%? Now can you notice that the P1 which was there over here, next year that is the P0. So every year's P1 is the P0 of next year. Clear? So if they don't give information and if they just tell every year end price, then you know what is the P0 for next year. This year's P1 will be next year's P0. So third year if you do 18 plus 105 minus 90 divided by 90, you will get 36.67%. Fourth year if you do 20 plus 80 minus 105 divided by 105 into 100, can you see? Minus 4.67%. How did we have a negative return over here? Because even though we got 20 rupees dividend, our price has fallen down by 25. Price has fallen down by 25. That's why you have a negative return over here. And last year also you'll do the same calculation. You'll get 40%. So now you have the holding period return of 5 years. So you'll just divide by 5. You got the holding period return of 35.88%. Clear? Now, if the same thing 35.88%, okay, which I told you, arithmetic mean doesn't consider the concept of compounding. It will only consider concept of simple average. It will not give you weighted effect. So now what will you do? Same thing. If at all we have to calculate compounded annual return, no. Then what you will do? Here it is 80%. So first year's return is 80%. So it becomes 1.8. Now this thing is specifically given. This negative was specifically framed to ensure that you don't make mistake in the exam. Now usually what will happen? If I tell you 30%, if I tell you like this, 30% return, 20% return and 10% return, nothing. You will do geometric mean very easily. You will tell third root of 1.3 into 1.2 into 1.1. Outside the root sign you will have -1. Simple. But when negative comes, there are chances of making mistakes. So first year's 80% is how much? 80% means what? 1.8. 27.5% means what? 1.275, because the formula is like this: 1 plus R1. R is 0.8 in decimal. So 36.67%. So 1 plus 0.3667, that makes it 1.3667. Now see the fun part. This is minus, no? So 1 plus, okay, minus 4.6, so 0.0476. So this minus and plus, it becomes minus. So that time, can you see you're getting only 0.9524. You're getting 0.9524. Then the last year is 40%. So 1.4. Last year is 40%. So it is just 1.4 minus 1. Minus 1 is there outside the root. When you do that, you know how to do that with the calculator technique. You're getting 33.14%. Can you see always geometric mean will always be less than arithmetic mean? Because this is going to give a compounding effect which will give the same return. Okay, that should be it with that particular example. So what you have to understand, if you have to calculate geometric mean, just remember that if there is a negative number, from 1 you have to minus that negative number. So it will become 1 minus 0.0476. Clear? Yes. Next, in the same multiple period return thing, we will take one more example. 2020 starting, the stock was at 100 rupees. 2020 starting, what was there? Stock was 100 rupees. 2024 ending, stock was 150 rupees. So now, can I just tell, oh, 150 minus 100, I got 50 rupees return, and 50 rupees return on my 100 rupees investment. So 50% is the rate. So per annum, it is going to be 10%. That is one way to look at it. That means you have taken arithmetic mean, simple average. Now other way, what you are going to do? It has grown from 100 to 150 in 5 years. So you will take the formula again. 150 is equal to 100 into 1 plus R to the power of 5. So that time what you got? 150 divided by 100. You got 1.5. That is why you have fifth root of 1.5 minus 1. That time if you calculate using your calculator technique, 8.45%. Okay, getting adjusted to the calculator technique again, you can use your calculator. Take 1.5 in your calculator, press the root sign 12 times. 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11, 12. 12 times you press. Next step is minus 1. Once you did that, you have a root symbol over here. Fifth root in fraction will become 1 by 5. So into 1 divided by 5. Then whatever minus 1 you had done, add that 1 back. You got a number in your calculator. Don't modify that number. Into is equal to 12 times. 1, 2, 3, 4. 1, 2, 3, 4. 1, 2, 3, 4. So you got some number there. Okay. Outside the root symbol, there was one minus 1. Minus 1 you do. Into 100 you do. 8.45%. Are you getting 8.45%, everyone? Yes. This is how you are going to calculate whenever you have fifth root. Because in your calculator, it doesn't support to calculate fifth root. Or you can also see 150, 8.45%. This can't be used if dividend is given in each year. If dividend is given, no, you can't use this future value, present value formula concept, because you can't tell that only the stock has grown from 100 to 150. Along with the stock growing from 100 to 150, no, every year you are going to get dividend also. So in that case, what you're going to do, you can only use the geometric mean formula. That means every year's return you have to find. Every year's return you have to find, and then you have to plot it into the formula and get the geometric mean. Are you getting this? Okay. Just remember, if you have only prices, then you can use future value, present value formula and calculate. But if you have along with the prices, P1, along with P1, you also have dividend. That time you will have to use the formula of geometric mean, that is individually calculate return. How will you calculate individually return every year? Every year you will have to do D1 plus P1 minus P0 divided by P0. Then you will get the returns. Then keep all the returns. Then you use the geometric mean formula. Clear? That should be it. Note. If data of past is given, okay, they have given the data of the past. That time you will prefer geometric mean. But if they give estimated data, that means they give data of the future. If they give data of the future, what will you do? You will calculate arithmetic mean. Arithmetic mean is preferred. Clear? Just remember this for examination questions. So with that, we have finished our discussion on return. Return of what? Single stock. We have only focused on single stock. Now, if you are able to calculate for single stock, then we have to calculate for multiple stocks, which will create a portfolio of stocks. Now, let's continue our discussion. We'll go into risk now. Risk. Deviation from expected outcome is risk. Now, for example, you have decided that for CMA Final, to clear CMA Final, you have to study particular number of hours. Now, tell me one thing. Every day, will you be able to study a particular number of hours? Same amount, every day, exact same. Minute to minute, second to second also, everything same. Is it possible? No. You have decided that at least on an average, you have to study 8 hours. One day you might study 8 hours. Yes. Okay, on an average, you have to study 8 hours. Not when you attend classes, but otherwise. Okay, once the classes are over and you're in your study holidays, that time you have to study 8 hours. Now, if 8 hours are there, some days you might study 9 hours, some days you might study 7 hours, some day you might study 10 hours with full josh, then you might study 6 hours. So on an average, can you see you're studying 8 hours? This is mean. What is this? Mean. You're taking the data of many days and you're telling on an average I should have at least minimum 8 hours. Now, what is risk? You know, risk is, now when you're studying, if you study more, there is no problem. If you study less only, there is risk. But imagine if you're talking about share price. Now we are telling share price, how much can it deviate? Deviate from its expected outcome. That means if I tell standard deviation, for example, your study hours, for your study hours, I'm telling standard deviation is 1.5 hours. Standard deviation of your studying is 1.5 hours. You know what does it mean? That means there is a potential that some days you will study 1.5 extra. That means you will study 9.5 hours. And some days you will study only 6.5 hours. That means basically if your mean is sitting at 8 hours over here, standard deviation means how much it can fluctuate upwards or how much it can fluctuate downwards from the expected return. Clear? Now we are talking about hours over here. So expected hours. So deviation from expected outcome is risk. Now lesser the deviation, lesser would be the risk. Now imagine two people are studying. One person's deviation is only 20 minutes. So someday they will study 20 minutes less, someday they'll study 20 minutes more. Higher the deviation, higher would be the risk. One more student is there. That fellow also averages 8 hours only, but the deviation is 3 hours. Someday they'll study 3 hours more with full josh, watching some YouTube motivation and all. And then someday they'll study 3 hours less. Okay, so therefore, if it is lesser deviation, lesser would be the risk. And if it is higher the deviation, higher would be the risk. So what I'm trying to tell you that if at all, now for example, I have stock X and stock Y. And stock X and stock Y both are having a return of 30% and 30%. Both are giving me return of 30% and 30%. Now, standard deviation of the stock is 10%, but here it is 5%. Now tell me, which stock will you prefer? Which stock will you prefer? Will you prefer X or will you prefer Y? X is giving you 30%, Y is also giving you 30%, but Y is giving you 30% with a less risk of 5%. So you will choose stock Y. But imagine you are a person who wants to take risk. You are a person who wants to take risk. Now you are thinking, the first what you thought, You're like, sir, both are giving me 30%. No, but here risk is only 5%. I'll take this one. But imagine if you think like this, sir, this is having risk of 5%. That means it can fall by 5%, yes. And it can rise also by 5% and it can become 35%. But imagine over here, this can fall by 20%. I'm ready to bear that. But imagine if it goes in the opposite direction and it goes higher, it will go and jump to 40%. So I'll be very happy that time. Clear? If you're a person risk averse, you want to take risk, then you'll go and take this one. Clear? Now, let's go further. If we can measure the extent of deviation, we have actually measured the risk. How to measure the deviation? We go back to statistics. Only way to measure the deviation is statistics. To measure deviation, we have to statistical concept called as standard deviation. Okay, we had this discussion just on statistics for one couple of hours, where we calculated how to, where we have seen how to calculate standard deviation for normal data and how to calculate standard deviation even for probability data. Clear? Now, stock selection we will see based on risk and return. If two stocks have same risk, two stocks are having same risk, what will you prefer that time? A stock which is giving you higher return. But if two stocks have same return, prefer the stock that is giving you lower risk. This is basically if somebody doesn't want to take risk. Okay, otherwise if someone tells it's okay, I will take the gamble, I will like, let's see till where it goes, I'll take 10% risk on a stock, then they can be sitting next year on 40%. Clear? Now, if one of the stock has both higher return as well as lower risk, see, one person has higher risk, other person has lower risk, then you have to see who is giving, both are having same risk, then you have to see who is giving higher return. Both are having higher return, you have to see who is having lower risk. But imagine some stock is there, it is giving you higher return also, and it has lower risk also. It has no competition with any other stock. So you will obviously choose that particular stock. Clear? If one of the stock has higher return, but also has higher risk, ayo, now there is a problem. Now see, what I'm trying to tell you is, imagine I tell you over here, there is X stock and there is Y stock. There is X stock and there is Y stock. Clear? And my return and there is risk. Clear? Return is 10% and here it is 15%. And risk is 3% and 3%. Now both are giving you what? Both are giving you same. Both are giving you same risk. That means which one will you choose that time? 15% wala. You will choose the one which is having 15%. Am I right? Now imagine I tell you same situation, but I tell you that X and Y, okay, both are having return of 10%, 10%, but here risk is 4%. Now what happens? Both same return, but it is one is having higher risk. So what will you choose? You will choose X. You will choose X because X is having lower risk. Now if at all I have a situation X and Y, return and risk, okay, X is giving me return of 15%, Y is giving me return of 12%. X is having risk of 3%, Y is having risk of 4%. Then what to do? Hands down, no competition, X only. X is having higher return also, X is having lower risk also. Now, so three situations, the problem is solved. Now the next one, imagine I have X and Y. I have X and Y and I have return over here. Okay, X the return is 15% and Y the return is 12%. But risk, if I calculate risk, X the risk is 4%, Y the risk is 3%. Now I cannot tell anything, no. I cannot tell one person has higher return and lower risk. I cannot choose that. Two people having same return, that is not there. Two people having same risk, that is also not there. So now we introduce one more formula, that is coefficient of variation. Statistical formula called coefficient of variation. How to get this coefficient of variation? Standard deviation divided by mean. Coefficient of variation tells us the percentage of risk on your mean. So basically what you will do, you will take risk is 4 divided by 15 into 100, you are having 26%, 26.67%. Here it is 3 divided by 12 into 100, 25%. So what will you choose now? You will choose Y. You will not choose X. X is more risky. Okay, risk percentage is higher. You will choose Y. So Y will be the stock that is going to be chosen. Is this clear till here? Yes. Now we'll go and see our discussion on risk. Now see, for example, if we have Infosys stock and we have Adani stock, two stocks, okay, expected return is 15% and 10%. Okay, expected return of both are 15%, but standard deviation you can see one is 5%, one is 10%. So can you see which is having 5%? Infosys. Can you see Infosys stock how it is going? It is going closer to its average. Adani stock you see 10%. It is going fluctuating more than its average. Okay, so in this case you can see Infosys stock is less risky because it is deviating less, and Adani stock is more risky because it is deviating more. Clear? Now example, same examples which we took that time, return and risk. If I have two companies giving same return, then I will choose which one? Invest in Y Limited. If two companies are having same risk, then I will choose which one which is giving higher return, then I'll invest in Y Limited. If let's say X Limited is having higher return also, lower risk also, then invest in X Limited. The last one is X and Y. You can see the coefficient of variation. Now X is having higher return but is having higher risk also. Y is having lower risk but is having lower return also. So therefore you will calculate coefficient of variation. Coefficient of variation formula is standard deviation divided by mean into 100. That time you will get it in percentage. Now which is having lower percentage of risk? Y. So invest in Y Limited. Is this clear? Are you clear with this? Now at this point of time we have actually finished our single security, risk and return. Now we go into portfolio. Portfolio, risk and return. Now portfolio return is damn easy. Okay, there is nothing to worry about portfolio return. Portfolio return what? Hey, that fellow is giving me this much, this fellow is giving me this much, this fellow is giving me this much. Okay, in my total, what is the weight of all these three people? Take the weightage and calculate. Done, finished. So return on portfolio, which is denoted by RP, return on portfolio is weighted average return on individual securities where beginning of the period market values are assigned as weights. So what you have to only thing that you have to remember, weightage what? Now we have calculated even WACC, no? In WACC what we have done? We have taken weightage. Which one we have considered as weightage? We have considered the market value as the weightage. Now here also we will consider market value only as the weightage. But market value which one? P1 na P0? We will be taking P0. Why? From there we have derived this return. No. From P1 we have not derived return. P1 is the end of the period value. So from P0 we have derived this return. That is why here the market values will be assigned as weights. Is this clear? Market value will be assigned as weight at all time, and if there is a confusion, just remember market value at the beginning of the year will be considered as weightage. So see the formula, summation RI into WI. What is RI into WI? So if I tell you there is one stock having 10% return, one more stock giving you 15% return, this is there in your portfolio, and in your portfolio this is 60%, and in your portfolio this is 40%. How did I get this 60% and 40%? Taking the market value. Taking the market value, not the book value, not the book value. So therefore, what will I do? 10 into 0.6 plus 15 into 0.4. So therefore, 6 plus 6 is equal to 12%. Clear? This is how you are going to calculate your portfolio return. Now, notes. Don't make the mistake of using number of shares or market price as weightage. The correct weightage is always market value. Clear? Don't make the mistake of using year-end market value, because year-end market value is sitting now. It didn't give you any return. From year one market value, you have created the return as weights. The correct weights are always calculating beginning of the period market value. Clear? If they don't give us a beginning of the period, then we always assume whatever is given us at the end of the year. Imagine market price. Imagine they are telling you that in X you have 100 shares, in Y you have 200 shares. Market price per share 200 and 300. Now they didn't tell you what was the price at the beginning. Whatever is given, we'll assume that it is at the beginning of the year. Risk of portfolio, we'll see that later. Now portfolio risk and return. Now see, we have two companies. Let's say two companies, Red Limited and Yellow Limited. Okay, complete concept discussion of portfolio we'll be doing today. So keep absorbing whatever is there, keep absorbing, keep using your calculator as well so that you understand the calculation. We have Red Limited and Yellow Limited, two companies. Red Limited has 50 shares. And yellow, in Red Limited we have 50 shares and in Yellow Limited we have 20 shares. And what is the market price? 30 rupees and 20 rupees. Return percentage. Okay, return percentage given. What is the return you are earning? How did I get this return percentage? This return percentage I got by calculating D1 plus P1 minus P0 divided by P0. Okay, now in this question it's already given, but in some other question it might not be given. So you'll have to calculate that. Okay, now you know the market value. How did we get 50 shares into 30? This is my market value. 20 shares into 20. This is my market value. That means what is my total portfolio value? 1900. That means 1500. That is 25% into 1500 divided by 1900 plus 18% into 400 divided by 1900. This should be your weighted average of the return. So that time you should get the answer. Clear? 23.53%. Are you getting 23.53%? Yes. This is your return of the portfolio. Clear? Return of the portfolio done. Now the major concept is risk of the portfolio. Risk of the portfolio. There is a small mistake over here. This should not be written like this. It is actually written like this. What is this? What is this? This is the standard deviation. Clear? So risk of the portfolio, this should be the symbol. There is a small typo there. Now, entire portfolio management. Okay. Major concepts of portfolio management is actually given by one guy called as Markowitz. What Markowitz is he? Harry Markowitz. Now Harry Markowitz has given a theory. This is also called as modern portfolio theory, or it's also called as modern approach, or it's also called as Harry Markowitz model, or it's called risk return optimization approach. Now if they tell you any of this, and if they tell you calculate the risk as per any of these terminologies, it is basically they are telling you to calculate risk of the portfolio as per Harry Markowitz model only. Clear? Now, risk of the portfolio is not weighted average risk of individual securities. Now, returns, they're like, sir, return simple, sir. I took weightage, no, and I calculated the return like that. But risk can I do like that? Risk I cannot do like that. Okay, risk I cannot do just weighted average. Instead, standard deviation P is less than weighted average. Standard deviation will be less because you know why? Now, if I tell this person is having risk of 5%, this stock is having 10%. Now, if I just take and I'm having 50-50 weightage. So what will I do? I'll do 15 divided by 2. That means 7.5% risk. No, it is not 7.5% risk because when they are going together, 1% risk will be compensated by other person's benefit. Now here what is happening? Imagine you have a stock, two stocks are there. One stock is going down. Okay, the other stock went up. So the response of one stock to another stock is also needed to be considered when you are calculating your risk of the portfolio. Therefore, you will also need to know covariance. What is covariance? Together, when they are together, what is their risk? On their own, they have some risk. On their own, this person also has some risk. But when two companies are together in a portfolio, what is their risk? Okay, so therefore, this is because multiple securities in the portfolio tend to offset each other's deviation. One stock is deviating, the other one will offset that deviation by going in the right direction. So the net effect of deviation of the portfolio will be less than the weighted average. So you can't just take weighted average. Clear? So risk of the portfolio is given by this particular formula. Small formula it is. Okay. Square root of standard deviation A means what? Stock A. It can be stock X, Y, Z, anything. First stock into weightage square. Standard deviation B into weightage B square. 2 into weightage 1 into weightage 2 into covariance of 1, 2. Now, imagine, sir, how to calculate covariance, sir, between A and B. Covariance of A and B will be basically, this we have already discussed in our statistical part, but we'll revise it again. Covariance will be summation AB divided by N. N means what? Number of years or the data which is given for number of periods. and A and B. How will you get A and B? A and B is not just A, B cut out multiplication. A in this case is A minus A bar. B in this case is B minus B bar. Okay, A minus A bar, B minus B bar. This you have to understand. Clear? Now A and A means what? The data that is given. A bar is what? The average of that data. So this is how you calculate covariance. Now imagine I have to calculate covariance of AB for a probability data. For probability data, what will I do? Summation of A minus E of A, okay, into B minus E of B into probability. A minus E of A. E of A is basically in probability data. E of A is the mean. So A minus E of A into B minus E of B into probability. This will give you the covariance. Now some questions might be there where covariance only is not there in the question. Now covariance is not there in the question. Data is also not given. So you can't calculate. So we learned one more thing in statistics, that is correlation. Correlation. Now correlation, what was the formula? The formula for correlation, one of the formula was covariance between A and B divided by standard deviation of A into standard deviation of B. So now what will I do? If I don't have covariance formula, if I don't have the data to calculate covariance, or covariance is not given in the question, I can get covariance by if they give you standard deviation. Standard deviation, if I know, I will just bring this side. That time it becomes standard deviation into correlation into standard deviation A into standard deviation B will give me covariance of A and B. Will give me covariance of A and B. Is this clear? This is the risk of the portfolio. This is what? Risk of the portfolio, and this is given by this model given by Harry Markowitz. Now you're like, sir, okay, simple. The formula looks simple. What is the formula now? Just remember, square root of standard deviation 1 into weightage 1 square plus standard deviation 2 into weightage 2 square plus 2 into standard deviation weightage 1 into weightage 2 into covariance between 1 and 2. If I don't have covariance in between 1 and 2, what will I do? 2 into weightage 1 into weightage 2 into correlation into standard deviation 1 into standard deviation 2. Clear? This is the formula. And now like, sir, simple, sir, the formula, no problem at all. Chillu formula it is. But what if there are 3 stocks? What if there are 3 stocks? You know how the formula will become when there are 3 stocks? Same thing, it will be, now there will be 3 stocks. So it will be standard deviation square root of, let me find some space. Yeah, it will be like this. See the fun of this formula now. Weightage 1 into standard deviation 1 square plus weightage 2 into standard deviation 2 square plus weightage 3 into standard deviation 3 square. Clear? Then it will become 2 into weightage 1 into weightage 2 into covariance of 1 2 plus 2 into weightage 1 into weightage 3 into covariance of 1 3 plus 2 into weightage 2 into weightage 3 into covariance between 2 3. This is how you will calculate if at all we have 3 stocks. If you have 4 stocks, obviously the formula will be bigger and bigger. So you can have a situation that you might have like 20 stocks, you will have to sit and do the formula forever. Forever you will be doing calculating covariance only. Now therefore when there are multiple stocks, we have a shortcut method also, which we will see later. Now this much we have to understand till here. Interpretation of covariance and all we'll see later. This is the formula, or this is the methodology to calculate the risk of the portfolio. Now when I'm going into the concepts, return we finish risk. Okay, one example I have taken to explain the risk. Now see, imagine I have been given year 2020, 2021, 2022 and 2023, 4 years. If they give me price, no, I am gone. If they give me price, what I should do? I have to calculate return and then start calculating. So XYZ is one company, ABC is one more company, and XYZ minus 4%, 12%, 15% and 20% return is there, and these are the returns of ABC company. Now just for our ease of calculation, Ease of calculation, what I have done, I have denoted XYZ company as X and ABC company as Y. Clear? So now, first thing, whenever we have to calculate risk, for calculating risk, what and all I need? I need risk of the stocks. To calculate risk of the stocks, I need to know how to calculate standard deviation. How to calculate standard deviation of any stock? Square root of summation x square divided by n. What is this x square? X square is x minus x bar square. Clear? So therefore, now understand this data. With this we can understand the complete situation. First, what I will do, I will calculate the mean. 43, take your calculator, 43 divided by 4. How many units we have? 1, 2, 3, 4 divided by 4. You got 10.75%. Clear? On par with this. Now you have 4 datas over here. 25 divided by 4. Your mean is 6.25%. Okay, keep running your calculator so that the revision happens. Now, x, we need small x. Small x is nothing but x minus x bar. What is x? X is the values that are given to you. What is x bar? The mean that we have calculated. So first thing what you will do when you are doing this in the calculator, the mistake that you can make is this is minus 4. So take in your calculator, take 4. Press the plus minus sign there. Make it minus 4. Then minus 10.75. Can you see you are getting minus 14.75? Next one, 12. 12 minus 10.75. You are getting 1.25. Then 15. 15 minus 10.75. You are getting 4.25. And the last one, 20. 20 minus 10.75. You are getting 9.25. This is your x values. X values are nothing but x minus x bar. Now I also need y values. Why do I need the y values? Y value I need y minus y bar. Without y values, I will not be able to calculate the risk of y stock. I will not be able to calculate without the x values to calculate the risk of x stock. So now y minus y bar. So here it is showing minus 10. Take 10 and press plus minus sign in your calculator. 10 minus 6.25. This is y bar. So you will get 16.25. Minus 16.25. Clear? Here you have 5. 5 minus 6.25. You should get minus 1.25. Here you have 20. 20 minus 6.25. You will get 13.75. And here you have 10. 10 minus 6.25. You have 3.75. Clear? You got your x values and you got your y values. Now you need x square, y square. What will you do? Whatever x values were there, you are going to square it. All the x values you are going to square it. Clear? This is your x square. Same way with y values, all the y values you are going to square it. When the negative also, when it gets squared, it becomes positive. Okay, now you have the total of your x square and total of your y square. What is one more that you need? For calculating covariance. Now x was what basically? X was telling us, x value over here was giving us x minus x bar, no? That means we are telling how this x stock is deviating from its average. And how this y stock is deviating from its average, correct? Now what we need, we want to know these both together, how will they deviate? So we need the covariance, so x into y. You will calculate x into y. Minus 14.75 into minus 16.25 will give you 239.69. Here you have to be a little careful about the negative symbols. 1.25 and minus 1.25 you will get minus 1.56. Here both are positive. When you multiply, you will get positive number. Here also both are positive. When you multiply, you will get the positive number. In our statistics discussion, we have done many problems on just this. Clear? Now you have this situation. Now what I need? I know both the companies' returns. I want both the companies' risk. How to calculate standard deviation? Standard deviation formula is square root of summation x square divided by n. If it is y, square root of summation y square divided by n. Now can you see over here, I have the x square values 322.74. So therefore for me standard deviation will be, standard deviation of x is basically 322, one second, standard deviation of x is square root of 322.74 divided by how many values we had? 4 values, 4. You will get some number. Take the square of that, you should get 8.98. Are you getting 8.98? Yes. For y values, what will you do? Standard deviation of y will be equal to square root of 468.74 divided by 4. You'll get some number, take the square of that, 10.83. Is this clear till here? Okay, this is your standard deviation. What do we need now? Covariance. Covariance, what was the formula? Covariance between x and y is equal to summation xy, small x and small y divided by n. So now what was the formula? 331.26. So 331.26 divided by n is 4. So when you do that, you should get a covariance of 82.82. Are you getting? This is basically preparing the data ready for our calculation. Clear? Our data set is ready. Correlation also we can calculate. What is the correlation formula? Covariance of x and y divided by standard deviation of x into standard deviation of y. So you can see this correlation computation over here and you're getting correlation of 0.85. Clear till here, everyone? Risk. Now we can calculate the risk. Now to calculate risk, I only know 2 stocks. No. Now someone has to tell me how much is the weightage. If they tell me market value, I'll take the weightage. Okay, now if amount invested in XYZ is 60% and amount invested in ABC is 40%. First, what I have to calculate? Imagine I have to calculate the return of the portfolio. Return of the portfolio, how will I calculate? I know the return of one stock, I know the return of one more stock. So therefore, it will be just 10.75 into 60%. And then it is going to be 6.25 into 40%. Clear? You will get the return of both the stocks together. That will give you 8.95%. 8.95%. Is this clear till here? Now what we are going to do? Standard deviation of the portfolio or risk of the portfolio. Risk of the portfolio. How will you calculate the risk of the portfolio? First, weightage 1. What is weightage 1? 0.6 into the standard deviation of the first stock. Standard deviation of the first stock was 8.98 square plus weightage 2 0.4 into standard deviation of the second stock 10.83 square plus 2 into standard deviation 1, sorry, weightage 1 0.6 into weightage 2 0.4 into covariance between 1 and 2 82.82. When you solve for this and you press the square root symbol in your calculator, you will get the answer for risk of the portfolio. So what you're going to do, you're going to solve the first part, put it in memory, solve the second part, put it in memory, solve the third part, put it in memory, take this MRC and take the square root of that. You should get an answer of 9.36%. Clear? If anyone is there who is not able to follow, now see, in exam what you should not do, I'll tell you. Standard deviation of portfolio you won't know. Now you have this number. You should not have one more step. One more step, you should not tell square root of this number plus this number plus this number. Then you should not have one more step telling square root of this total number. You should not do this. If you are not knowing how to do this, learn it once. First, you press the MRC button in your calculator 2 times to release all the old memory which is there. Okay. Now, 8.98. Take 8.98 into 0.6. Okay. Square into is equal to. Clear? That time you got the square. Press M plus. M plus when you press, it is getting stored in memory. Second, here 10.83 into 0.4. Okay, once into is equal to. You got the square part of that, press M plus. Then 2 into 0.6 into 0.4 into 82.82. Press M plus. You got the number, press MRC. You have some number that is showing 87.55 in your MRC right now. This is variance. This is variance because standard deviation square is always variance. We want standard deviation. So press the square root symbol. You'll get 9.36%. This is your standard deviation. Is this clear? Any doubt with this? No. Now we did it for 2 stocks. Now we have to see what if there are 3 stocks. Okay. Now, if there are 3 stocks, now the formula just gets bigger. Return of the portfolio, no problem at all. Okay, return into weightage, return into weightage, return into weightage. 100 stocks are there also, no problem. We'll calculate that. Standard deviation of the portfolio, we had discussed this. Standard deviation A into weightage of A square. Standard deviation B into weightage of B square. Standard deviation C into weightage of C square. Then what you're going to do, 2 into WAWB into covariance between A and B. 2 into WAWC into covariance between A and C, 2 into WBWC into covariance of BC. We'll take one example for that as well, which makes our data set very, very small. Okay, so now I am taking three companies, X, Y, and Z. X, Y, and Z. 2023, 2024, 2025. 3 years data is given. 25, 30, and 25. Okay, now what will you do? Calculate. Now what and all you require? You need X values, Y values, Z values. What is this X value, Y value, Z value? X minus X bar, Y minus Y bar, Z minus Z bar. First you need to know this stock is deviating how much on its own from its average value. Then you will get X square, Y square, and Z square to calculate the standard deviation. Then you need to know X and Y on their own, how they are between themselves, how they are covariating. So you need the covariance for X, Y, X, Z, and also Y, Z. This much data is required. Okay, now what will you do here? You took the 90 divided by 3, you got 30 as the average return. Here the total is 30, 30 divided by 10, 30 divided by 3, you will get 10 as the average return. And then third one is 55. 55 divided by 3, you are getting 88.33. 55 divided by 3, 18.33. Clear? These are your means. So here what will you do? X minus X bar, you will take 25 minus 30 minus 5. Then next you will do 30 minus 30, you will get 0. Then you will do 35 minus 30, you are getting 5. For Y minus Y bar, 12 minus 10, you are getting 2. 8 minus 10, you are getting minus 2. And 10 minus 10, this you can use your calculator fast and tell me how much is it? 0. Clear? Now Z. Z is 15. 15 minus 18.33 minus 3.33. Then 10 minus 18.33, you are getting minus 8.33. And 30 minus 18.33, you are getting 11.67. You got the data already. Now what you will do? X square. Then you are going to do Y square. Then you are calculating Z square. You got your values. Now what we need after that? X, Y. X and Y, whenever you calculate this part of the data table, that is X, Y, you have to be very careful. First of all, you have to be very careful when you calculate X, Y, and Z. What is negative should be written as negative only. Otherwise, your entire calculation will go wrong. X square, Y square will not go wrong. Because if it is negative also when you square it, same number. If it is positive also when you square it, is same number. So, now X into Y, this is minus 10. Here 0, very happy 0. Here also 0, very happy 0. So, your XY ka total is minus 10. Now, X into Z, minus, this will become positive 16.65. Here it is 0, so it became 0. Okay, and here 5 into 11.67, you got 58.35. Is this clear? Now, YZ when you are calculating, Y into Z, this is negative, so this will become a negative number. Here, these both are negative, so this will become a positive number. And this is 0, so it will become 0. This is the data set what you have created. What and all you require now? You need standard deviation of X. Standard deviation of X. So what you will do? Square root of X square, which is 50, divided by N, which is 3. So 50 divided by 3, take the square root, you should get 50 divided by 3, square root 4.08. 4.08 will be your standard deviation. Can you see 4.08 over here? Now for Y, what you will do? Standard deviation for Y square. What was Y square? 8. 8 divided by 3. Take the square root of that. Are you getting 1.63? Then for Z, what will you do? Square root of 216.67 divided by 3 and take the square root of that. You will get 8.5. Clear? Now XY, XZ and YZ. XY, how to get the covariance between X and Y? XY total minus 10 divided by 3. So you get minus 3.33. Then for Y, XZ, what you are going to do? 75 divided by 3. That is going to give you 25. And this is going to be 10 divided by 3, but positive this time. So it will be 3.33. Okay, now weightage. Let's say weightage is given in the question 20%, 30% and 50%. Now you have to calculate. Okay, this was my return on X, 30 into 0.2. This was my return from Y, 10 into 0.3. This was my return on Z, 18.33 into 0.5. So you're getting 18.17%. This is your return on your portfolio. This also you're going to calculate one thing, 30 into 0.2 M plus, 10 into 0.3 M plus, 18.33 into 0.5 M plus. Press MRC, you should get 18.17%. 165, you can make it as 17. Clear? Now standard deviation of the portfolio. Standard deviation of the portfolio. You have the data set ready. First it is 4.08 into weightage. So 4.08 into 0.2 square. Take your calculator, 4.08 into 0.2 into is equal to M plus. Okay, next. 1.63 is the next standard deviation. 1.63 into weightage. So 1.63 into 0.3 is equal to you press M plus. 8.5 into 0.5. So 8.5 into 0.5 square. Press that into memory. So you took standard deviation of each and weightage of each. Then what will you do? 2 into 0.2, 0.3. Between x and y when you are calculating, 2 into 0.2 into 0.3 and their covariance. Their covariance is how much? Minus 3.33. So this you have to be careful. 2 into 0.2 into 0.3 into 3.33. You are actually getting negative number, no? It should be negative number, no? So because it is negative number, what you are going to do? Don't press M plus, press M minus. M minus. Then next we are calculating between x and z. X and z 2. Where is it? X and z 2 into 0.2 into 0.5. Clear? Between covariance between x and z is how much? 25. This is positive. So take your calculator. 2 into 0.2 into 0.5 into 25. This time you press M plus. Press M plus. And here y and z 30% and 50%. So 2 into 0.3 into 0.5 into their covariance is how much? 3.33. So 2 into 0.3 into 0.5 into 3.33 and press M plus. That time you will press MRC. MRC should be showing you 24.566877. One number will be there. Take the square root of that, you get 4.96%. Is this clear? This is what you will do if there are 3 stocks. But as I told you, if there are 3, 4, 5, 6, 7 and all, it becomes headache, no, to use this formula. So there is a shortcut method which is called as matrix method. Now what happens in the matrix method? First I will display it, then I will tell you step. Actually there is no formula or anything or steps, but we have just written the steps so that it becomes easy to remember. You know what you have to do in matrix method? 2 stocks. First we will see the 2 stocks. X you write, Y you write. Done. X, Y you write. Write their weightage on top. Remember when we had 2 stocks, what was their weightage? The weightage was 60% and 40%. No. Where is it? Yeah. 2 stocks when we calculated. 60% amount invested. Here it is. 60% and 40%. So what you will do in matrix method is, you will take X here, write the weightage, Y here, write the weightage. Same way you write on the other side also, X here 60%, Y here 40%. Clear till here? Now what you have to do, you have to fill this table. Once you fill this table, it becomes damn easy. First you have to write X and X. What is the covariance between X and X? X and X between themselves, there is no covariance. It is called as variance. So what you will do, you will go to the, we have already calculated and kept the data. X and X, 8.98, no. So 8.98 square, what is it giving you? 80.64. Fill the table with 80.64. Clear? Now, Y and Y, see over here, Y and Y will also be, see this is Y and this is Y. Y and Y will not have covariance, they will have only variance between themselves. So Y, you go and check what is the standard deviation of Y, 10.83 square. So you're getting 117.29. Can you see you're getting 117.29? This is the variance. Now you have filled X and X, you have filled X and Y. Now what you have to do? You have filled X and X and you have filled Y and Y. Now this column is what basically? Covariation between X and Y. Covariance between X and Y we had already calculated. Covariance between X and Y was 82.82. Fill the table, 82.82. Covariance between Y and X is also 82.82 only. Now you know when you have this matrix method, no, you have the calculator. Keep the calculator ready now. What you have to do is finish each row properly. Here it is 80.64. Take 80.64 in your calculator. 80.64 into 0.6. Upwards, whatever you have written weightage, sidewards, whatever you have written weightage, into 0.6. Press M plus. Clear. Next, go to the next column. 82.82. 82.82 into 0.4. Sidewards into 0.6. M plus. Then 82.82. 82.82 into 0.6. Okay. Into 0.4. M plus. Then 117.29 into 0.4 into sideways 0.4 M plus. You're getting MRC. Whatever you get in your MRC, take the square root of that. 9.36%. Are you getting 9.36% over here? This is the matrix method. Now, if you want, I can write the steps for that. Step 1 is box 1, any box into weightage on top into weightage on the side. Step 2, repeat for all the boxes. Then step 3, press MRC. Then step 4, press the root sign, because you are calculating the standard deviation of the portfolio, not the variance of the portfolio. This is called as matrix method. Now what we'll do, if at all, for 3 stocks. 3 stocks. We already did it normally, for 3 stocks. Now 3 stocks, you see, I wrote XYZ and I wrote XYZ. Then I put their respective weightage, 0.2, 0.3, 0.5, 0.2, 0.3, 0.5. Remember our question, the weightage was given 0.2, 0.3, 0.5. Can you see over here 20%, 30% and 50%. Now I have to fill. Whenever I am filling, first I will always fill X, X, variance, Y, Y, variance, Z, Z, variance. Between themselves, they cannot have covariance, they will have only variance. So go to our calculation, which we have already done. What is the standard deviation of X? 4.08. 4.08 square. How much you're getting? 16.65. Go and fill it. 16.65. Filled. Y, what is the standard deviation? Y, we got 1.63. 1.63 square. 2.66. 2.66. Z, what is the standard deviation? 8.5. 8.5 square. 72.25. 72.25. Now what I have to fill? X and Y. X and Y, their covariance, as well as Y and X. See, X and Y in the table are sitting over here, and X and Y are also sitting in the table over here. So I'll go and fill. What was the covariance that I got for X and Y? Minus 3.33. So I'll go and write minus 3.33 over here, minus 3.33 over here. Then what I have to fill? X and Z. X and Z, they are sitting over here. Then also there is X and Z sitting over here. So go and check what is the covariance. We had gotten the covariance as 25. Go and fill that 25 over here. Fill the 25 over here. Then we had Y and Z. Y and Z, they are sitting over here. Y and Z. And also Z and Y, they are sitting over here. It's the same thing. So go and check what is the covariance. Covariance, covariance, covariance. 3.33. Y and Z. You're filling it over here, also filling it over here also. Now our step is what? See the step 1. Step 1, each box. Keep completing each box. Box into weightage on top into weightage in the side. So first you will take 16.65 into 0.2 into 0.2 M plus. Then you will take minus 3.33. Take 3.33 in your calculator. Press the minus symbol, plus minus symbol, into 0.3 into 0.2 into 0.3 into 0.2 M plus. Then you take 25 in your calculator. 25 into 0.5 into 0.2 M plus. Now you finish this full row. Next row 3.33, but 3.33 in your calculator, press minus symbol. Okay, plus minus symbol, make it negative. Into 0.2 into 0.3 into 0.2 into 0.3 M plus. Then 2.66 into 0.3 into 0.3. 2.66 into 0.3 into 0.3 M plus. 3.33 into 0.5 into 0.3. 3.33 into 0.5 into 0.3 M plus. Then 25. 25 into 0.2 into 0.5. 25 into 0.2 into 0.5 M plus. Then 3.33 into 0.3 into 0.5. 3.33 into 0.3 into 0.5 M plus. Then 72.25 into 0.5 into 0.5. 72.25 into 0.5 into 0.5 M plus. You will get one number in your MRC. Press the square symbol, 4.96%. Clear? This is your matrix method. Obviously, if there are 4 stocks and all, you cannot sit and prepare the formula for that. So you can always prefer this matrix method. Clear? That should be it. This is our discussion on risk of the portfolio. When there are 2 stocks, when there are 3 stocks, more than 3 stocks, please don't make the formula. You use the matrix method itself. And in the exam, if there are more than 3 stocks, no, 100% they will not give you data table. They will give you variance of X, variance of Y, variance of Z, variance of A, whatever it is, they'll give you. Okay, then you will just be calculating it. Okay, next. We'll go into the next one. Interpretation of covariance and correlation. Covariance. Okay. Interpretation of covariance and correlation. Now you have seen over here, covariance, if you get negative, what is the formula for correlation? Covariance into sigma X into sigma Y. Correct? Standard deviation X into standard deviation Y. Now, if at all this is the formula, and see over here, if covariance comes negative, obviously correlation also will be negative. And if covariance is positive, correlation also will be positive. So in this case, just understand, denotes co-movement of 2 securities. Covariance means what? The variance when the 2 securities are going together. Okay, that is how the 2 securities will move together. If covariance is positive, then the 2 securities will usually move in the same direction. Covariance is negative, then 2 usually will move in the opposite direction. If covariance is positive, then correlation will also be positive and vice versa. Now, this we have to understand. Okay. Interpretation of covariance and correlation. Now imagine there are 2 people. One person is called as Aditya. One more person is called as Aditi. 2 people are there. Imagine they're like, we have to learn some new skill in life and they go to salsa class. You know salsa? It's a dance form. Okay. They go to salsa class. They have to hold hands and they have to dance. Now, if covariance is there, no, covariance or correlation, imagine the correlation is positive. If correlation is positive, when Aditya keeps 1 step, Aditya also will keep 1 step in the same direction. And when Aditya keeps 1 step backwards, Aditya also will keep 1 step backwards. So they are dancing together. Clear? Now, obviously, Aditya's leg is big. So his 1 step might be little bigger. You're not telling that, oh, they're keeping exact measured steps. No. Aditya's leg is big, so he'll keeping little bigger step he'll be keeping. Aditya will keep little, but they will move together. Clear? Imagine if the correlation is negative. They had a fight before they went to that dance class. No, they had a fight. Their correlation is negative. Now when Aditya is keeping 1 step that side, no, Aditya is keeping 1 step this side. Okay, then their hands are just like this, holding each other. So this is when correlation is negative. If a stock goes in a positive direction, other stock will go into negative direction. Is this clear? Okay, this is basically correlation. Now imagine if correlation is 0. Correlation is 0. See, no correlation. That means anything can happen. Okay, if a stock goes upwards, the other stock can go upwards also, it can go downwards also, or it cannot move at all also. So this is the interpretation of covariance and correlation. Now, I want to give one example. Let's say it is perfect. See, I have given one table here. When it is -1, it is called as perfect negative correlation. And when it is +1, it is called as perfect positive correlation. Okay, that means when it is perfect negative, we know whatever happens, opposite will happen. Whenever it is positive, we know whatever happens in one direction, the same thing will happen in that direction. Clear? Then the correlation is moderate and weak. And here also it is weak and moderate. If it is 0.3, 0.7 and all. And if it's 0, there is no correlation at all. Now, we have to understand this interpretation of covariance and correlation. Now, when we are doing the interpretation of covariance and correlation, understand this thing. Let's say I take one example where A has a standard deviation, A has a return of 10%, B has a return of 16%. And the correlation is standard deviation is 5% and 9%. Now, did you understand? This is going to be our data set for our complete discussion on this. Interpretation part, this is going to be our data set. Clear? Now, example if I take an example. Perfect positive correlation. What does perfect positive correlation mean? Okay, what does perfect positive correlation mean? Yes. What does perfect positive correlation mean? Perfect positive correlation means if this goes upwards, that will also go upwards. Correct now? Now, if I tell you stock A is 10% and this stock A which is 10%, it went and became 20%. Now you're like, okay, sir, I understood. Stock A which was 10%, it became double. It became double. Yo. Technical timeout. Okay, stock A which was 10%, it became 20%. That means it became double. So am I telling that stock B which is 16%, it will also become double and will become 32%? If I write like this, answer is wrong. This is my wrong interpretation. So now don't think that stock A, it went and became double 20%. That means stock B from 16% will become 32%. No, this is wrong. This is completely wrong. Now you're like, okay, sir, I understood now. Stock A, no, it became 20%. That means stock A had a 10% increase. Stock B 16% will also have a 10% increase. It will become 26%. That is also wrong. That is also wrong. That is not how it is. Now, what you have to actually understand, it's a covariance. It's a correlation. Correct? Now, if stock A has become from 10% to 20%, that means how much was its variance? 5%. 2 times of its variance, it has gone up. Covariance was calculated using variance only. So 2 times of its variance, it went up. That time it became 20% the price of the stock. Clear? Now, if I tell you stock B, we have 16%, but stock B's variance is not 5%. No, stock B's variance is how much? 9%, and 9% 2 times of its variance. 9 into 2, that means stock B will go up by 18%. So 16 plus 18, it should become 34%. It should become 34%. Can you see the correct answer is this? Stock A became 20%, stock B 16% plus 16 plus 9 into 2. That becomes 34%. Can you see? So just double the values is not the answer. Add the same percentage, not the answer. Covariance was decided based on the variance of the two parties. So what you're going to do in this case, you're going to tell, okay, your variance was 5 and you have increased 10%. That means 2 times of your variance you increased. Mine also variance is 9. I will also increase by 2 times. That time you will get the new percentage as 34%. Is this clear till here? Now, let's say perfect negative correlation. Perfect negative correlation. I am telling stock A from 10% it became 20%. Oh, jump to double jump. So what we are telling, oh, 16% it became 0. Wrong, we have seen it cannot happen like that. Okay, stock A we are telling 10% became 20%. Okay, 10% increase. That means here I will do 10% decrease and make it 6%. Is that right? No, that is also wrong. This is also wrong. So basically next what we are going to do? Next we are going to do stock A 10%. From it became 20%. That means variance was 5%. 5% into 2, 10% increase. 5% into 2, 10% increase. Clear? Stock B, what we are going to do? 16%. 16% minus 9 into 2. 2 times decrease it will happen. That means negative return of minus 2%. Clear? It became negative return of 2%. Note, if there is no correlation, the movement of one stock will have no impact on other. Clear? The next topic is, we finished our discussion on correlation and risk. Minimum construction of a portfolio, that is minimum variance portfolio or minimum risk portfolio. This is what we are supposed to do next. Let's take a small 10 minutes break. Okay, let's go into the next discussion now. Constructing a portfolio. What is our next discussion? Constructing a portfolio. Okay. Minimum variance portfolio, or it's also called as minimum risk portfolio. The formula is simple. Okay. Wx is equal to, Wx is what? If imagine you have stock X and stock Y. You can take any one. You can take stock Y also and calculate, stock X also and calculate. Wx is equal to, if you take X over here, then you will take variance of Y minus covariance between X and Y. Then in the denominator, you will take variance of X also, variance of Y also, minus 2 into covariance of XY. So basically, it's like an averaging out formula. Okay, now X is safe investment or less risky investment, Y is risk investment. Doesn't matter. If you give X and Y, anything you take and calculate, you will get the answer. But if you take X over here, then this will be variance of Y minus covariance of XY. If you take Y over here, this will be variance of X minus covariance of XY. Denominator will be fixed. Variance of X plus variance of Y minus 2 into covariance of XY. Is this clear? This is a small formula constructing a portfolio which has a limitation. What is the limitation? You can do it only if you have two stocks. You can calculate this and you can use this methodology only if you have two stocks. If you have multiple stocks, you cannot use this methodology at all. Clear? So let's go into one example for that. Construction of minimum risk portfolio. Let's say I have stock X, variance is 84, stock Y, variance is 90, and covariance between X and Y you are getting 60. So what will I do? I'll calculate WX. WX means what? I'm trying to find the weightage of X. If I'm trying to find the weightage of X, I'll take variance of Y. Variance of Y is how much? 90 minus covariance between X and Y is how much? 60. The whole thing divided by, what will I do? Variance of X also I'll take, variance of Y also I'll take, minus 2 into covariance of XY. So first in this case, in the exam, what you will do? First you always calculate denominator. Okay, 84 plus 90 minus 2 into 60 is 120, so minus 120. 84 plus 90 minus 120. Put that in M plus. M plus, you put it in your memory. Take your denominator. 90 minus 60 is 30. 30 divided by, you want that one which is sitting in memory, divided by MRC, memory recall, will give you 55.55%. 0.5555 into 100 if you do, 55.55% is the weightage. Now obviously, you can apply the formula again for the other one also. If you apply the formula for the other one, how will it look? WY is equal to variance of X. What is the variance of X? 84 minus covariance of XY 60 divided by 84 plus 60 minus 2 into covariance of XY 60. Clear? You will get 44 point some percentage. When you do this, you will get the 44. Otherwise, you already calculated for one. Other one is just 100 minus other thing. Clear? You already calculated for one. You don't have to do it again for the other one. You will just do 100 minus 55.55%, which will give you 44.45%. Is this clear till here? This is your minimum risk portfolio. We'll see one more situation over here. Minimum risk portfolio. Example, X limited, Y limited. Return is 12% and 18%. Okay, standard deviation is 11% and 19%. So imagine I just normally calculate. Normally calculating means what? I'm just writing X, Y, two companies, and I'm keeping different options. I'm telling 1 over here, 0 over here. That means 100% I'm going to invest in X limited and 0% I'm going to invest in Y limited. I change the proportion. I put 80%, 20%. And then 60%, 40%, then 40%, 60%, then 20%, 80%, and then fully in Y. And if here we have already written return of the portfolio. Return of the portfolio, how will you calculate? If 100% is going to be in X limited, take X limited's return and write as the return of the portfolio. And if 80-20, if it is 80-20, what will you do? 12 into 0.8 plus 18 into 0.2. That time you will get 13.2%. 13.2%. Next, if you do 60-40, 60-40 if you do, what will happen? 12 into 0.6 plus 18 into 0.4. That time you will get 14.4%. And same thing you are going to do again 40%, 60% and all the other things also. You will be able to calculate the return of the portfolio. Now, risk of the portfolio, you see, risk of the portfolio. Imagine correlation is equal to 1. Correlation is equal to minus 1. Correlation is equal to 0.2. So all three options we have chosen and we have kept. If correlation is equal to 1, first of all, if I am in this situation, I don't have to bother about anything. Because here 100% is going to be in X, no. 100% is going to be put into X. That means risk will be of X only. There is no correlation. So risk will be of X. So you're going to write 11, 11 and 11%. Whereas here 100% we are going to put into Y only. So risk will be of Y itself. Y's risk is how much? 18%. Sorry. Y's risk is how much? 19%, 19% and 19%. Clear till here? Now the problem is to calculate what is the risk of the portfolio if there is 80-20 weightage. Now get ready with your calculator. What will happen over here? The formula is going to be like this. 80-20 weightage, 0.8 into standard deviation 11 square plus 0.2 into standard deviation 19 square plus 2 into 0.8 into 0.2 into covariance of 1 to. Covariance of 1 to we don't have. Covariance we don't have one in this question. If covariance is not there, what we will do? We will use a correlation. Correlation is how much? 1 into standard deviation 11 into 19. You should get 12.6% that time. Clear? Did you get 12.6%? Yes. Yes. So did you understand how we are going to calculate? Here what is the correlation? -1. So my formula will look like this. If it is -1, it will look like this. Okay, 0.8 into 11 square plus 0.2 into 19 square plus 2 into 0.8 into 0.2 into, we don't have covariance, correlation. Correlation is -1. -1 into 11 into 19. That time this will be minus. Remember that. Okay, so be careful when you calculate. You will get 5%. You will get 5%. So this is how we have filled the table. Different correlations are there. Different correlations are there and different weightages are there. Now, the table is not created just to calculate, just to teach you how to calculate risk. Risk we already know how to calculate. So I just told you how these numbers we came from, where we got. We took these weightages and we took the correlation. Now the main thing over here is, see, when it was this particular weightage, no, then there is no calculation of minimum risk or anything, because all are 11, 11, 11, 11. When it was 80-20 weightage, no, 80-20 weightage, see over here, the return was 13.2%, very high return. Okay, but risk was 12.6% if it is correlation 1 and 10.26% if it is correlation 2. Clear? That means, can you see at this weightage, among all the things we are seeing, at this weightage we are having the least risk. At 80-20 weightage we are having the least risk. Now, but whereas correlation, when it was negative, that is giving me the least risk when there is 60-40 weightage. Are you getting this? 60-40 weightage, because there only 1% we had. Now, this is to tell you that there is not complete clarity about that formula, that minimum risk formula, no, which will not give you the complete accurate number. It will just give you an approximate number. Now you see, if I calculate minimum risk portfolio when correlation is equal to 1, what is my formula? 361. What is 361? 361 is basically variance of y. Variance of y, 19 square if you take, you will get 361. Variance of y minus correlation I don't have. Correlation, I mean covariance I don't have. So what I'll do? Correlation into sigma 1 and into standard deviation 1 into standard deviation 2. This will give me the covariance. Clear? Now what will I do in the denominator? This is 11 square. 11 square means 121. So 121 plus 361 minus 2 into covariance. We don't have covariance, so correlation into standard deviation 1 into standard deviation 2. You will get 152 divided by 64. Can you see what you are getting here? You are getting 2.375. But whereas the minimum risk portfolio was 80-20. 2.375 in derivatives terms means one you are going to sell and one more you are going to buy. Okay, so sometimes you will not get accuracy in this particular formula. If you see 0.2 as correlation, no, that time you are getting 80-20. Can you see 0.2? It was giving you 80-20 only. And when you see negative correlation, can you see you are getting 63 and 36? But we were getting how much? 60-40. So can you see you are not going to get complete accuracy. You will get reasonable accuracy with that particular formula. But if they tell you minimum risk portfolio, you are not going to sit and make a table with different proportions. You are going to use that minimum risk portfolio formula and you are going to calculate. Clear? That was just to demonstrate how it works. Next, let's go further. Next one is efficient frontier. Efficient frontier will tell us multiple things. This efficient frontier is also called as Harry Markowitz model, Markowitz portfolio theory, modern portfolio theory, minimum variance set and risk return optimization approach. Now you have to understand what is this efficient frontier. Now see, one day this Harry Markowitz in US, he was sitting. Okay, he was completely jobless. He didn't know what to do only in life. So what he did is he took one graph sheet. He took one graph sheet and he told this is risk, this is my return. This is risk and this is my return. And he started making different portfolios. Different portfolios of different. Now, for example, he took every single stock in the market, okay, and calculated, made a portfolio. 2 stocks portfolio, 3 stocks portfolio, 4 stocks portfolio. He made different portfolios. Now, for example, if I have to explain in Indian terms, no. Imagine Harry Markowitz came to India and he told, okay, Tata is a good company. Tata Motors I'll take and Reliance I'll take. I'll make a portfolio of this. 90-10, 80-20, 70-30, 60-40, okay, 50-50. Like the different proportions, just these 2 stocks. Then I'll be like, okay, Tata, Reliance and Infosys. All proportions of this. And when I take this, no, Tata and this thing, Reliance, it will give me some return, it will give me some risk. Now I'll go and plot it over there in the graph sheet. I'll go and plot, this portfolio is giving me 8% return, but it's having 4% risk. I plot it on the graph sheet. Like this, he kept doing for all the stocks which was there in US Stock Exchange. Every single stock he kept doing. Imagine how jobless he must have been, okay, and how much time he would have consumed. Not doing for 2 itself, no, it will require multiple attempts because 2 different weightages will be there. You have to calculate return, you have to calculate risk. He kept doing that and he kept plotting the numbers. Okay, it will actually not look like this. The actual Harry Markowitz efficient frontier will not look like this. You can't see so much gaps between the things. He has plotted so many numbers that it will be very close to each other. It will be looking like one huge forest. Like this. Okay, so now he kept doing that. He kept doing that. Now, when he did that, ultimately he noticed that there is a graph like this on top. The graph like this on top, he said, take investors, take this. This is the ultimate thing. Take this efficient frontier graph. Now, you are a person, you are ready to take 4% risk. Okay, for you the best portfolio is this. You are a person who is ready to take 12% risk. For you the best portfolio is this. So at every risk point, he had the best portfolio in his situation. Now imagine you are a person who wants to get 22% return. Now 22% return at any cost, you want 22% return. Then for you, this is the portfolio. You are a person who wants 22% return, but you don't want to take more than 10% risk. Then for you, this is the portfolio. 22% return. So Harry Markowitz attacked us. Pencil stopped working. Yeah. Now see. Now imagine someone looking at this. How does it work? Every single portfolio he has calculated return and risk, and he has put it into this graph. And this graph has all the numbers. Okay. Now it looks like this. This is the ultimate topmost part. Okay. CML, capital market line, it's called. Capital market line. This line he called it as capital market line slope. Can you see it is in a slopey order? Now imagine a person wants 22% return. Then at any cost, then he'll go and check, oh, this is the best one at the top, but it's okay. I have to take 16% risk. I'm fine with this. Imagine he tells, I want 22% return, but I don't want to take more than, let's say, 14% risk. 14% risk, if you see, 22% return wala portfolio only is not there. Can you see now? If you want to get 22%, I have to take that much risk. Now, imagine someone is telling, I am ready to take 10% risk only. What is the best portfolio for me? Best portfolio for me is something that gives me 16% return. Here, imagine someone tells, I want 10% return. Okay, I want 10% return, but I'm not ready to take more than 8% risk. 10% risk return, okay, 6% risk you're getting it. Or someone like 12% return, you're sitting over here 12% return. But there is at 10% risk, there is also a portfolio which is giving 10% return. So he plotted all this and he got this. Obviously, they can't ask this graph in the exam. This is just to understand. Now, with this, we got our capital market line. The topmost line which is there is called as capital market line. And that market line is called as CML slope. Using this, they can ask you to calculate the return. Now, here what happens? CML slope means capital market line slope RM minus RF divided by standard deviation of the market. RM is market rate of return, RF is risk-free rate of return, and this is standard deviation of the market. So what does this indicate now? For every 1% risk you are going to take in the market, how much return you are going to get? Imagine I tell that my RM is 18%, my RF is 10%. Okay, that means extra return in the market is 8%. And if I tell my standard deviation of the market is 2, so 18 minus 10 divided by 2, I will get a percentage called as 4%. So what does this 4% indicate? This 4% indicates for every percentage of risk that you are going to take, you will get 4% return in the market. Okay, this is called as CML slope. Now imagine you are a person who is ready to take 5% risk. You are ready to take how much risk? 5% risk. 5% risk you are ready to take. Now what will you do? With that you will calculate your expected return. Expected return will be RF is 10%, that you will get for sure. Now for taking risk, what will you get? RM minus RF, 18 minus 10 divided by 2, you got the 4% there. 4 into 5, that means 20%. So 10 plus 20, 30% return you can expect. Did you understand how this slope is going to help us? Now this slope is going to tell us that, boss, you are ready to take 1% risk, that will give you 4% return in the market based on this data. It can be some other data also. So now this is what happened with that CML slope, which we got from the efficient frontier. Clear? Now note, when you construct a portfolio comprising of risk-free asset, risky asset, either a single security or a portfolio on an efficient frontier, then overall return and risk of such combination is always weighted average. Overall return and risk, it is going to be weighted average only. Whether you take risk-free asset or risky asset, you are going to take weighted average. Now let's take one example for this. Okay, RF is 8%, RM is 18%, same. Okay, standard deviation of the market is 4%. So now standard deviation of the portfolio is 6%. So CML slope, you see 18 minus 8 divided by 4. Okay, you got 2.5%. What does this 2.5% indicate? For every percentage of risk that you are going to take or willing to take, you will get 2.5% of return. So if you take 1% risk, you will get 2.5% extra compared to RF. RF has zero risk. FD, if you keep, you will get 8%. You are ready to take 1% risk. This will keep going higher and higher and higher. Clear? Expected return is 8% you will get for sure. 2.5 into what is your risk percentage? 6. So 2.5 into 6, 23% will be your return. This is how you calculate expected return using the CML slope. Okay, one more example. RF is 5%, RM is 15%, standard deviation of the market is 6%. So standard deviation of the portfolio is 9%. That means I am willing to create a portfolio where I want to take risk of 9%. I am willing to create a portfolio where I want to take risk of 9%. So what efficient frontier will tell you, boss, you are ready to take 9% risk. This is the return you can get, and this is the portfolio combination. I don't even have to search. I am ready to take 9% risk. You tell me which is the portfolio. That full graph, if you look, you'll find one portfolio there, and you go and invest in that. 15 minus 5, okay, divided by 6, 1.67% is the slope. So that means every 1% risk increase in return is 1.67%. So therefore expected return is 5% plus how much risk you are ready to take? 9. 9 into 1.67, you will get 20% return. Is this clear? Can you see how this CML slope works? Now next you go into the next thing is called as corner theorem. Someone saw Markowitz. That fellow's name is Corner. That fellow didn't like Markowitz. He came with some different theory altogether. But that theory, whoever came with any theory after Markowitz, they always kept some calculation of Markowitz as the base. That means they did not start any calculation from zero. They had to keep Markowitz theory only as the base, and then they made some modification. Now, Corner theorem, you see, according to Corner theorem, there exists a linear relationship between three lines forming a part of a portfolio lying on efficient frontier. In efficient frontier, whatever is there, there is a relationship between the stocks. Now here, linear relationship means degree of change in weights between any two securities will be in the same proportion. Okay, now basically they are telling, now tell me one thing, Tata and Reliance in the efficient frontier, how many times they are there? Numerous times. Why numerous times? Tata and Reliance together, they have numerous times. Why? Because they have weightage 10 and 90, then weightage 20 and 80, like that in different weightage category they are sitting, correct? So this is the formula with which you are going to solve y is equal to mx plus c. But there is a simple understanding of that. Corner theorem, no, instead of using formula, you can understand with simple understanding. But then for getting marks in the exam, you have to use the formula and you have to solve. Clear? Now, see this corner theorem. Understand this corner theorem. Forget all the colored lines. Ignore all the colored lines. Just focus. In the efficient frontier, there is one portfolio sitting over here. In the efficient frontier, there is a portfolio sitting over here. And in this portfolio, A 40%, B 30%, and C 30%. Clear? This is the amount of weightage that is there in this particular portfolio. Now, little higher in the efficient frontier, same A, B, C are there. But there the weightage between A, B and C has become 30, 50 and 20. Now what institute will ask you is, they'll ask you a question. Now here you're sitting, boss. If I want to go higher in that, A is 20%. How much is B and how much is C is the question they will ask. So they are telling. Now what Corner said? Corner said relationship between one stock increase decrease will linearly affect the relationship between other stocks also in the portfolio. So he is telling this went from 40 to 30, 10% down, and this went from 30 to 20, 10% down. So whatever happened when it changed over here, same thing will happen there also. So he is telling when it went from 40 to 30 over here, this went from 30 to 50. Are you following this? When A went from 40% to 30%, B went from 30% to 50%, 20% increase. That means when A again goes from 30% to 20%, B will go from 50% to 70%. Is this clear? B will go from 50% to 70%. This is your corner theorem. Okay, now what has happened? When A went from 40% to 30%, now C is there, no? C you can just calculate as balancing figure also. 20, 70, 90. That means this C has to be 10%. But the theorem will also work. See, for when A went from 40 to 30, 10% down, C went from 30 to 20, 10% down. So when A again goes from 30 to 20%, C will go from 20% to 10%. This is the actual understanding. Corner actually just made a graph and told, see boss, there is a relationship between the portfolios which are sitting on your efficient frontier. So if weightage increases, the others also will get linearly affected in the same manner. But exam you can't solve like this. You can't write the answer for this in the exam like this. Exam you have to use the equation itself. Okay, y is equal to mx plus c. Clear? Now understand this. Y we are trying to calculate for, let's say, B. We are calculating for whom? B. We are trying to find B and C. No, A is already given. So now understand this. 0.3 is equal to 0.3 is equal to, what is 0.3? 0.3 is B. Okay, y is equal to mx. M we don't know. M is an imaginary number which we have to figure out. 0.4 plus C. 0.4 plus C. So we are keeping the change of A as a relationship and we are trying to find B. So when B was 0.3, A was 0.4 M plus C. Now when B became 0.5, A was 0.3. So 0.5 is equal to 0.3 M plus C. This is how you are going to solve. Y is equal to mx plus C. X is the x values, y is the y values. M and C we have to find. Okay, so now if I take this as equation 1 and equation 2, what will I do? I have to minus. When I minus this, it becomes minus 0.2. When I minus this, it becomes 0.1. This is C. C will get cancelled with each other. So minus 0.2 is equal to 0.1. Now bring this 0.1 this side. So minus 0.2 divided by 0.1. M is equal to minus 2. M is equal to minus 2. Clear? So now you got M. What will you do? Substitute M here. You will get C also. 0.3 is equal to 0.4 into minus 2 plus C. So this becomes minus 0.8. Take this that side, it will become plus. So 1.1 should be the C. Can you see 1.1 over here? You got M and C values. Now you want to calculate whatever you want, you calculate. You will be able to calculate. Now see, y is equal to 0.2. Now see, x became 0.2. No, x became 0.2. So now what I will tell? Oh, y is equal to 0.2 into M. M was how much? M we already calculated. It was minus 2. So I am telling y is equal to, now I will find the y values when whatever change in x values happen. X values, y is equal to 0.1. Sorry, my bad. Y is equal to 0.2. 0.2 into m is how much? Minus 2. Plus c. C is how much? 1.1. So now what will you do? Point is 0.4. Minus 2 into 2. 0.4. And from that, you remove 1.1 because you are going to have negative and positive situation. Y is equal to 0.7. Can you see? You got the weightage of y. You got the weightage of y. Now, can I do the same circus with for calculation of c also? We want to calculate c. Y is equal to, y is c for me this time. Y is equal to mx. M is how much? Minus 2 into x is how much? 0.2. X is how much? 0.2 plus c is how much? 1.1. How much will I get? Again 0.7 only. I'll get 0.7. That means for one stock you can calculate, for the other one it has to be balancing figure. Because the formula is intact. It will not change at all. So for one stock you calculate, for the other one it will be balancing figure. Clear? This is what you are going to present in the exam. Examination presentation is going to be like this. You are going to use the formula y is equal to mx plus c. When will you use this situation? Whenever they tell you that two portfolios, okay, from one portfolio to another portfolio, this was a change in the weights. Now if I create another portfolio, x weight is this much, how much is y and z? That time you are going to use this particular formula. Clear? That should be it with that particular situation. Then capital allocation line, just for theory, for understanding, capital allocation line versus capital market line. What is capital allocation line? You know what is allocation? Whatever is there in the efficient frontier, no? When we saw the efficient frontier of Markowitz, we saw that so many investments are there, right? So many investments. Me doing different types of investment, it is actually allocation. That is capital allocation. But the best investment is capital market line. Clear? I have funds, I can invest in this also, I can invest here also, I can invest here also, I can invest here also. But this is all called as capital allocation. Now, best allocation out of that is your capital market line. Now see the concept over there. When RF asset is combined with risky assets, that means risk-free asset is combined with risky asset, then various possible portfolio combinations are presented by capital allocation line. Now you have risk-free asset, you have risky asset. Now you have different combinations where you can go and invest. That is called as capital allocation line. When risk-free asset is combined with tangency point efficient frontier portfolio. That means when risk-free asset is combined with the efficient frontier, that is market portfolio, then a line that represents various possible portfolio combination is called as capital market line. That means what we are trying to tell, the best allocation is the capital market line. Here CML is a special case of capital allocation line where risky asset is used in market portfolio. CML is also termed as optimal CAL. Capital market line is the best capital allocation line. Is this clear? Yes, this is why we have this concept. You can get in MCQs, they can ask you just that much. Otherwise, for problem solving and all, we don't have to bother about it. Now, portfolio review. Next thing that we are going to learn is portfolio review. What is portfolio review? What is portfolio review? Now you created portfolio, you saw the risk and all that. Now you have many stocks in your portfolio. Some you want to keep, some you want to remove. Okay, that is portfolio review. And first one is concept of dominance. Concept of what? Dominance. Now imagine there is one person like this. Okay, there is one more person. Sorry, one more person is there. Like him only. Okay, same. But this fellow went to gym. Now, who will dominate whom? This fellow will dominate the other. Correct? Now, imagine this person is there, no? Non-gym going person. One more person is there, non-gym going only. Same. Didn't go to gym. So, no muscles. No domination can happen. So, this fellow went. You saw between the persons with same height, same weight, but one fellow is gone to gym, that fellow is dominating. Now, this fellow is there. Imagine one more guy is there who has not gone to gym. One more guy is there who has not gone to gym. Who will dominate whom now? Who will dominate whom? This fellow will dominate this guy. No, this fellow will dominate this guy. So this is what is the concept of dominance. This is what is the concept of dominance, but we have to see with return and risk point of view, not from the height point of view or weight point of view. Clear? Now, to dominate the other securities in the portfolio, a security must have any one of the below properties. So to dominate, imagine you are a security in one portfolio. If you want to dominate somebody else, then you should have, out of the three what we are going to see, you should have at least one property. For the same level of risk, it has higher return. Somebody else is having same risk as me, but I am earning higher, so I will dominate that person. Clear? Now, for the same level of return, it has lower risk. That means me and someone else in the portfolio is having same return, but I have lower risk, so I dominate. Otherwise, clear domination is what you know. Clear domination. You have higher return also, lower risk also. You have higher return also, lower risk also. This is called as the concept of dominance. Using this concept of dominance, what you are supposed to do? You have to eliminate certain stocks from your portfolio so that you get your best portfolio which is there. Now note, whether to apply concept of dominance or coefficient of variation in a particular question. Like, hey sir, we have all these things, return risk, I can use coefficient of variation also and tell. Now, if question asks for selecting more than one security, apply concept of dominance. You have to select more than one security. Then, if they are telling to select only one, then you have to use coefficient of variation. You know why? Because imagine we can choose multiple stocks. Okay, multiple people are there. Oh, this fellow gym guy, this fellow dominated, this fellow out. Clear, this fellow out. Now, this fellow, these both are of same height, this fellow dominated, this fellow out. Now you have 1, 2. This fellow unique person. Didn't go to gym, but he has gun in his hand. Can you see? He didn't go to gym, he has gun in his hand. So obviously he'll dominate others. So therefore, if you want only one person, no, then you calculate coefficient of variation. This fellow will be the most unique. You will dominate everyone and will be out. Clear? But coefficient of variation, what happens? You will get percentage of risk for every single stock. If you want multiple, how will you do? Someone has to tell you cutoff point is this much. Then I will choose everything in that cutoff point. So they said in the exam, do simple calculation. If they tell you to select more than one security, no, then you don't do CV. You don't do coefficient of variation. You calculate concept of dominance itself. If they're asking you to select only one security, then what you have to do? You need to know the best one. In concept of dominance, after dominating also 2-3 people might remain. So therefore you will choose coefficient of variation at that particular point of time. Clear? Now we'll take one example for concept of dominance. One second. Now understand, forget about the cross symbols. Cross symbols are the one which got dominated. Now if you just focus on XY, XYZ ABC. XYZ ABC. I have 6 stocks or 6 portfolios. It can be 6 stocks or 6 portfolios. Now, can we have a portfolio of portfolios? Can we have a portfolio of portfolios? Now I have ABC in one portfolio. Can I have many portfolios like that? XYZ, PQR, LMN. Now I will take these two. So portfolio is nothing but mutual funds. Mutual fund is actually a portfolio. You put money into mutual fund. They will invest in multiple companies. Now you have actually invested money in one portfolio. Now somebody might be like taking, having money, putting money into one mutual fund and one more mutual fund. It became portfolio of portfolios. Is this clear? So now imagine this can be portfolios also and this can be stocks also. Now returns are given 12, 11, 12, 18, 16, 24 and risks are also given 8, 8, 6, 8, 11, 15. Now understand this one. Okay, understand this very, very clearly. What I will do is first always see the company which has the highest return. The highest return is 24%. Now I have to see, is there anybody else giving me same? Nobody is there who is giving me same. Okay, that means I can't be dominated by anybody else. No? How could this C be dominated? This C could have been dominated if somebody else was giving 24% at lower risk. Now, whatever risk I am going to give it at, doesn't matter. No one can bother me because I am having the highest return. So when you have the highest return, you can get dominated only if someone else is giving the same return at lower risk. Is this clear till here? Okay. Now C can never be dominated. Gone. Now we are going to see after C, what was the next highest return? Next highest return was 18%. Now if someone has to dominate A, someone has to give 18% at lower risk. Nobody is giving 18% at lower risk. What is the other way someone can dominate A? A is not the topmost person. No. Topmost person can be dominated only if someone is going to give same return at lower risk. Now there is someone who is going to give higher return than A. So if A can be dominated by C, for A to be dominated by C, C has to give higher return also, but at lower risk. But C is giving higher return at higher risk. So they cannot dominate me. Are you getting this? This concept of dominance can be asked in the exam, which you have to be very, very careful. First, what I will do, my starting point is always looking at the person who is having highest return. Highest return is C. C is giving 24% return. Anybody else giving 24% return? No. That means C can never be dominated. When can C ever be dominated? If somebody else is giving 24% return at lower risk. So C is done. C can never be dominated. Now less than C was A. A was giving 18% return. Is there anybody else who is giving 18% return? No. Now nobody is giving 18% return. So somebody is not giving 18% return. If they would give 18% return and they would give it at lower risk percentage, then A would get dominated. So now that has not happened. How else A can get dominated? Somebody should give higher return than A at lower risk. Somebody should give higher return than A at lower risk. Let him A will get dominated. C is giving higher return than A, but not at lower risk. C is giving it higher risk. So A didn't get dominated by anyone. Okay, after A, what is the next highest return percentage? 16%. After 24 and 18, the next highest return percentage was 16%. Is there anybody else giving 16%? No. That means nobody has given the same return at lower risk. But can you see over here, this fellow is giving 16%. Somebody is giving higher. How much is he giving? 24. Oh. But is he giving 24 at lower risk? No. That means C did not dominate B. Is there anybody else giving more than B? Yes, A. A is giving 18%. Oh. Now what happens? He is giving more than me. Is he giving more than me at lower risk? Yes. Can you see I got dominated by A? Why should I invest in B when A will give me 18% at 10% risk? Are you getting this? But if you're talking about these two, why should I invest in A when C is giving 24%? Because C is more risky. Are you getting this? If I'm comparing B and C, if you ask me, why should I invest in B, sir, when C is giving me 24%? I should invest in B when C is giving me 24% because C is more risky. But if you ask me, why should I invest in B when A is giving 18%? I should not invest in B because A is giving me 18% at a lower risk percentage. So B got dominated by A. Can you see B went off? After that, after 16%, the next smallest return was how much? 12%. Now you see two people are giving 12%. Two people are giving 12%. When two people are giving 12%, the person who is giving at lower risk will be chosen. So Z remains. X got eliminated. Now that after that, the last percentage is 11. Is there anybody else giving 11%? No. But there is somebody giving 12%. So 12%, but at same risk. So Y got dominated by X itself and X got dominated by Z. And if you look at the other way around, no, Y is giving 11%. When Y is giving 11%, Z is giving 12% at lower risk. So Z also dominated by. So Y got dominated by X. How did Y get dominated by X? Same risk, higher return. Y got dominated by Z. Higher return, lower risk. Is this clear? Higher return and lower risk. This is the concept of dominance. I have written the theory also for you. So ultimately in this, who remained? Z, A and C are remaining. So Z, A and C will be chosen. Clear? Now for you to understand X and Y. Between X and Y, X dominates Y because of higher return at same risk. Then if you see X and Z, Z dominates X because of same return at lower risk. X and Z. Yeah, same return at lower risk. Now if you see Y and Z, Z dominates. Why? Because of higher return at lower risk. Clear? Then you see A and B. A and B are these two. A and B. A dominates B because of higher return at lower risk. Clear? Nobody dominated C. That is the situation that you have to understand. That is called as theory of dominance. After that, the next thing what we have to see is arbitrage pricing theory. Now, expected return versus required return. Clear? Next thing is many questions can appear from this expected return versus required return. Yes. Now, sir, when I see this expected return and required return, I feel both are same. Expected return and required return, both are same. Is it same? No. What is expected return? Expected return is what you can get, what you feel you can get. Required return is what you want. Required return is nothing but your K, and required return will always be computed under CAPM. Expected return from where I will get? Expected return I will get by doing calculation, forecast, valuation. Remember we had valuation charter. There I will calculate return. This is my expected return. Next 3 years I am telling FCFF. Based on this FCFF, I calculated present value of the company, divided it by the number of shares. I got divided by number of shares and also the return. When I computed, I got my expected return. Clear? So understand this. How much return can we actually really expect to earn on investment is actual expected return. How much can I earn? Okay. Expected return is found by conducting research and analysis on the particular stock, by forecasting, valuation, etc. Doing the forecasting or doing the valuation, you will get the expected return. How much return should we demand from an investment given the risk involved? That is CAPM. How much should I tell I want at any cost? That is my CAPM. Now tell me one thing. Which is good? Expected return being more than required return or expected return being less than required return? Expected return being more than required return is good. See, my required rate of return is 10%. At any cost, boss, I want 10%. I am not going to sit quietly without 10%. And expected return is 12%. Good, no? That means this stock is performing good. This is called as undervalued. This is called as undervalued stock. So go and buy that stock. Good. Are you getting my point? Expected return is 12%. Required return is 10%. I want 10%. Some stock is giving me 12%. When I want 10%, that stock is giving me 12%. That means undervalued situation it is. Okay, that means go and buy that stock because it's going to give you 12%. Now imagine my required rate of return is 10% and expected return from that stock is only 6%. What will I do holding that stock? Holding that stock, I'll get only 6%, whereas I want 10% over here. So take that stock and throw it. That is overvalued. That means you're going to sell the stock. Expected return is 10%. Required rate of return also is 10%. That means what? Properly valued. Hold that stock. It is serving your purpose. Clear? So now understand this. This is called as alpha. This is called as alpha. And when we go further, you will all also see this is called as Jensen's alpha. This is called as Jensen's alpha. That means who found out this thing? Jensen. So his name came Jensen's alpha. Alpha means excess returns over and above required rate of return. Simple. Keep it very simple. Expected return minus required rate of return. If you get positive, that is positive alpha. If you get negative, that means negative alpha. Positive means good. That means you should buy. Buy you will buy. When will you buy? Only when it is undervalued. Negative alpha means what? Bad. When will you sell? Bad means you should sell it. When will you sell? When it is overvalued. Clear? Actual return or expected return minus return as per CAPM. Alpha is positive, denotes good performance. Okay, then you will go and buy. Alpha is negative, denotes poor performance. That means you will go and sell. Is this clear? Now, next after that we follow CAPM. We already know from beginning of our subject itself we are discussing CAPM. But CAPM is also called as security market line. What was one more line which we saw? Capital market line. What is capital market line? CML is basically RM minus RF divided by standard deviation of the market. This is capital market line. This is telling me that for every percentage of risk that I'm willing to take, how much extra return I will be earning. Okay, CML is what? CML is CAPM. That means we are telling RF plus beta into RM minus RF. What does this indicate? They are telling that RF I am anyways getting. My stock is sensitive to the market. So how much extra I will earn from that, or how much less I will earn from that. Clear? That is it. Note, there are two alphas in our syllabus, in your syllabus. One is alpha, which is called as characteristic line, which we'll see later. One more alpha is this expected return minus return as per CAPM. RJ is return as per CAPM. Is this clear? So this one is something called as characteristic line, which we will see little later in our syllabus. I mean, in this chapter only, little later we will see it. Now there is one more person. His name was Arbitrage. Okay, that guy, no. That fellow told, boss, what you're telling RF plus beta into RM minus RF. You're telling risk-free you're getting 6%, and then you're telling beta is 1.5. Beta is 1.5 means what? You're telling compared to what? Market. If market is 8%, 8 minus 6 is 2%. 2% is called as risk premium. So you will get extra 2% in the market if you invest in market. But I am not planning to invest in market. I am planning to invest in this XYZ stock. So XYZ stock is fluctuating 1.5 times of the market. If market goes up, XYZ stock will go up by 1.5 times. If market goes down, it will go down by 1.5 times. Is this clear? So now in this case, what happens in this situation? In this situation, we have to understand that this beta is there. No, it is only focused on the market sensitivity. It is focused only on the market sensitivity. So arbitrage pricing theory said, boss, your expected return is not only based on market sensitivity. It can be sensitive to weather condition also. Weather condition change, because of that there might be a sensitivity on your stock, and there might be a political condition also. Because of that also there can be an effect on your stock price. There can be also legal factors. Some new law is getting enacted. It will also impact your stock. So they said, take RF. Then you take different betas. This is the beta to sensitivity. Apply on the risk premium over there. This is the beta on the weather condition. Apply on the risk premium over there. This is the beta on the legal factors. Apply the risk premium over there. So they said use this formula when there are multiple betas based on multiple sensitivities. So we can take an example for that. You can see over here, return is equal to RF plus beta into RP1, P2, all that is given. Now see, I have given one example where I am telling that RF is 8%, RM is 15%, beta is 1.1. This is CAPM. This is CAPM, correct? No, only this much if I see, it will be called as CAPM. Now I am telling RM, okay, RM Forex. Based on Forex, I am expecting the RM to be 12%. Beta of Forex is how much? 1.2. So now RM political conditions 14. Beta of political condition is what? 0.8. RM legal conditions 15. Beta of legal is what? 1.5. So now what will you do? 8% plus 1.1 into 15 minus 8. Here it is 15 minus 8, normal sensitivity. Then this is written as per CAPM. But when I go into other conditions, what I will do? I will do 12 minus 8 into the beta of Forex. 14 minus 8 into the beta of political conditions. And 15 minus 8 into the beta of legal conditions. So if you look at this, you'll get 28.1%. This same arbitrage pricing theory can also be asked in questions where they give you expected return and actual return. That also can be taken, and difference between actual return and expected return can also be considered as risk premium for your arbitrage pricing theory calculation. Now what you have to understand, if you generally understand or try to make sense out of this, 1.2 beta means Forex conditions, whatever is there, no, it will impact me 1.2 times. So if there is some change in the Forex market, it will impact me more than one time, which will impact the market. Now, political conditions 0.8 means political changes won't impact my company much. Legal conditions 1.5 means if new law gets enacted, no, it will impact my company 1.5 times what it will impact the market. Clear? This is arbitrage pricing theory. Expected return versus required return. I think we had discussed this. This also I have put one example for your understanding. Now see this, situation 1, situation 2, situation 3. expected return is 25%. What is expected return? Expected return is what you can forecast, what you can get based on valuation. Clear? Required return is what? Required return came directly because of CAPM. What you should derive, what you should get for taking that much risk. So therefore, expected return 25, required return is 18. I told you, if alpha is positive, you are always going to tell it is undervalued. So if you see expectation, you are getting 25. What you want is only 18. Very good. You'll be very happy. So therefore, this is undervalued. Buy. Keep on buying that stock. Clear? Alpha is 7%. Buy. Whenever you see alpha positive, buy. Situation to expected return is 12, but you want 18%. Alpha will go into negative. If alpha is negative, sell. Do not keep this stock at all. You just sell this stock. Clear? Now situation 3 is 18. That means properly valued. Hold it. Be happy and hold that particular stock. Is this clear? Yes. This is our discussion till here. After this, we go into classification of total risk. Till now, what we did? We only computed risk. What did we do? We computed risk. We did not do classification of total risk and all. How did we calculate risk? Risk of the portfolio, risk of the stock and all was denoted by standard deviation. If it is single stock, we'll get standard deviation of the stock. If it is multiple stocks which made a portfolio, then you'll use Markowitz theory. You'll use Markowitz theory to find the portfolio risk. Portfolio risk was given by that formula. Standard deviation of the portfolio is equal to square root of weightage and all those things. Covariance, correlation, everything we have seen. Clear? Now classification of total risk. Understand this. Classification of total risk. Very, very important point. Now, whenever I am telling total risk, here classification is variance. Not the standard deviation, variance. Variance of any stock. Variance of I means variance of any stock square. Standard deviation square. Can be two types of risk. One is called as systematic risk. One more is called as unsystematic risk. Systematic risk means what? Systematic. When you think of that only, you can think system-based risk. That means market-specific risk. This can be computed. Okay, this one will be computing. Unsystematic risk means what? Company-specific risk, which cannot be computed. This will be the balancing figure whenever they ask us to calculate. Now, this was according to Markowitz. Later, one guy will come called as Sharpe. Sharpe told, boss, I will tell you how to calculate unsystematic risk also. So there we will see how it is done. Otherwise, unsystematic risk is just the balancing figure. Now see, this is the country. And here in Bengaluru, we have one company sitting over here. Clear? Now this entire country is denoted by Sensex and Nifty. Now what happens in the market? It will impact you directly. Correct? It might not impact the same level or higher level or lower level, but it will impact you. Okay, if it should not impact you, you should be a risk-free person. That means your bonds. That also government bonds. If your company bonds, again risk is there. We saw in bond valuation, we saw duration, volatility and all we have to calculate. So now understand this. If you are a person who is set up company over here, if there is a company over here, the country will have a risk impact on you. The country's economy will have a risk impact on you. The country's inflation will have a risk impact on you. That is not under your control. That is market specific risk. The market specific risk, we can calculate because we have information of market. Okay, and we know what is our sensitivity with market. So we'll be able to calculate. But the second one is there, unsystematic risk. That is firm specific risk. Firm specific risk is because I set up business over here in Bengaluru. That time no one was there in next 500 kilometers. Next, every 2 kilometers, somebody started making the same business. Competition. Firm specific risk. How will you compute this? It is not possible to compute firm specific risk because firm specific risk is separate for different firms. Clear? Then imagine there was some legal action taken. You gave some faulty products, and because of that, legal action was taken only on your company. When it was taken only on your company, again it is firm specific risk. And best part, what? You invested money into this company and went to sleep. You're like, forget, I invested money and went to sleep. Who will do the work? Who will do the work in the company? Board of directors. You hired one crazy board of directors. The board of director you hired, you put that fellow into work and you went to sleep. and you went to sleep and you told boss, you don't wake me up at all. Like Kumbhakarna, I'll be sleeping only. Don't wake me up at all. Wake me up only on the AGM date. Wake me up only on the AGM date. On AGM date, I'll come and see what has happened to this company. On AGM date, company has already gone down, about to close. We are standing outside on the road. We are seeing conducting the AGM. Okay, now that is because of what? The management that I have hired. Correct? The board of directors that I have hired. The board of directors doesn't perform. Obviously, the company will become more risky. Clear? Board of director only is involved in some scam. Then obviously company will be under scam itself, right? So therefore, this is called as system. This is called as firm specific risk. This is not under the control of anyone. It can be different. Now imagine this fellow has bad CEO. Next company has very good CEO. So obviously that company will be better. How will you compute it? It's not possible to compute. That is why you calculate total risk of your business. Total risk is always calculated based on your deviation, statistical measure. Then you calculate market specific risk. When you get the market specific risk, the balancing figure will be your firm specific risk. Is this clear? Yes. Now, let's not go there. Let's read this. Firm specific risk, how to calculate, I'll tell you. Till today, we calculated CAPM so many times, correct? And every time in CAPM, there was one thing called as beta. This beta, directly in the question they used to feed into our mouth, they used to put. We should take it and just calculate. This beta has to be computed. This beta will help us to compute the firm specific risk. Market specific risk. Total risk is measured by calculating standard deviation. We know, or basically variance. This is the total risk. Systematic risk is risk due to external factors, non-diversifiable risk, or it's also called as uncontrollable risk. It's not under your control. Now tell me one thing, if you are a person who has company, which risk you don't mind it being big? Systematic risk or unsystematic risk? You don't mind unsystematic risk being big. You know why? Because this is under your control. CEO is not working properly, you'll change that person. Product is not working, you'll change the product. You'll make it more better in the market. So therefore, systematic risk is called as uncontrollable risk. Now, is measured by calculating beta. Systematic risk is measured by calculating beta. Unsystematic risk is risk due to internal factors. It's called as diversifiable risk or controllable risk, residual risk. Okay, different words they can use. Company sector specific risk is measured by calculating E square. Or you can also see EI, you'll see it like this, EI square. This is a symbol that is given for unsystematic risk. It is given for what? Unsystematic risk. Now, factors shown visually contributing to total risk is, what are the factors that contribute to your total risk? First, they are telling political factors. Political factors are systematic risk or unsystematic risk? Systematic risk. Not under your control, no. Who becomes PM is not under your control unless you are some people in the country. Imagine you are this guy. Who is this guy? Bambani. Now, if you are Bambani, no, then it doesn't matter. For you, it is unsystematic risk because you will only control. Interest rates. Interest rate changing, RBI will do, and that will impact us. This is not under our control, systematic risk. Clear? Next, inflation rate it's not under my control, systematic risk. Exchange rate, dollar going up and down, not under my control, systematic risk. GDP growth rates, GDP again not under my control, economy of the country, systematic risk. Global supply chain issues. Now, for example, I am selling oil over here. The oil got blocked at Strait of Hormuz itself. It is not able to cross that person. Supply chain is affected. Now, is it under my control? No. Systematic risk. Unemployment rate. More people started studying, but that much jobs are not there. Is it under my control? No. Again, it is systematic risk. Geopolitical factors. Trump said something. It impacted my company. It impacted market. It impacted my company. Again, it is systematic risk. Clear? Management quality. Not good. Our management is not good. Unsystematic risk. This is under my control. Product quality. Cheap product I've manufactured. Unsystematic risk. Under my control. Labor strike. I didn't pay them, so they went on strike. I pay them, they come back. Unsystematic risk. This is called as company specific risk. Is this clear? The examples. Now, our next discussion is completely on to calculate systematic risk and to calculate unsystematic risk. And unsystematic risk is just a balancing figure. Okay. Beta is a measure of systematic risk. Beta will signify or beta will indicate the Systematic risk. It measures how sensitive a particular stock is with respect to changes in the market. What will beta tell us? How sensitive the market is to your stock. Your stock is to the market. Note, beta is never calculated between two securities. Beta is always calculated between a security and the market. What logic, man? Between two securities, if you are calculating beta, that fellow went and hired one person as CEO. Will it impact your company? No. But in market, if the GDP changes, will it impact your company? It will impact your company. So therefore, beta is always calculated between one stock and one particular market, and beta is never calculated between two particular stocks. Is this clear till here? Okay. Now, methods to calculate. Methods to calculate beta. Once we calculate beta, then we will get to know the other things. Beta, see the first formula for beta. Ignore this one, covariance. This we already know. How to calculate covariance? Other formula for covariance is correlation into sigma x into sigma y. Clear? That formula is just a sub formula which is written over there. We don't have to worry about that. Now beta, understand the first beta. Beta formula, two formulas are there for beta. Third one is just very, very rare cases we'll use in the exam. Now beta is, what did you think till now beta was? How your stock is going to move with the market? Now see, beta is covariance divided by variance of M, means variance of market. That means, understand this, me along with the market, how much there will be a variance, divided by only market, how much there will be a variance. That means that extra movement that is happening, that is my sensitivity. So covariance divided by variance of market. Me and market together, our stock and market together, it's going to vary so much. Variance is there so much. And only market is moving only this much. That means that is your beta. That is your beta. Is it clear? So basically, beta is equal to covariance divided by standard deviation. Standard deviation, no, variance of whom? Market. So I can also tell beta is equal to covariance xy divided by, covariance between x and m. X is basically your stock and m is market, divided by sigma m square. That is the variance of the market. That is the first formula. Second formula is beta is equal to correlation into sigma x divided by sigma m. Correlation xy, no, you can take correlation xm. Correlation into sigma x divided by sigma m. Always remember, your stock will be on top and market will be bottom. Clear? Correlation is your correlation with the market only, no. Correlation into standard deviation of stock divided by standard deviation of market. These are the two formulas for beta which you have to remember. Now guess what? To get to covariance, now again you have to prepare the data table. If somebody tells you compute beta, you have to calculate x, y, small x, x square, y square, covariance. Till there you have to calculate everything. Okay, so beta is equal to this formula or beta is equal to this formula. If at all the information is not there, and very rare cases, you can use this formula as well. This is percentage change in the stock divided by percentage change in the market. This is our last option to calculate beta. Clear? So three options we have. Again, what is the first formula for beta? Covariance xy or covariance of stock and market divided by variance of market. Then second formula is correlation into standard deviation of stock divided by standard deviation of market. Third formula is percentage change in the stock divided by percentage change in the market. Is this clear till here? Now, note, investment decisions using beta. Now, how will you take some investment decision using beta? If market is expected to be bullish, market is expected to be bullish means what? Market is expected to go up. If market is expected to go up, when market goes up, you want your stock, okay, wherever you are investing, you want it to react more, no? You want it to react more. So prefer investing in high beta stocks, because such stocks are always called as aggressive stocks. Now, if at all market is going up, market is going up, I didn't invest in market, I want to invest in stocks. I want to invest in those stocks which will react more. So if the beta is more, obviously I'll get higher return. But imagine market is going down. That means market is expected to be bearish. If market is expected to be bearish, I don't want to sit on a stock which is having beta of 2. Then market goes down 1%, my stock will go down 2%. So I want to sit on those stocks which have beta less than 1. That means if market goes down by 1%, no, I should go down by 7.7%. So prefer investing in low beta stock. Okay, such stocks are also called as defensive stocks. Such stocks are called as defensive stocks. Is this clear till here? Are you clear with this? Now, if you are calculating beta of the portfolio, we'll go to that later. We'll calculate just the beta of this particular, what do you say? Let's see, if they give me data like this and tell me compute beta. What is the formula for beta for me? Covariance of stock and market divided by variance of market. Clear? Now, we have X is denoted by market here and Y is denoted by stock. So, if this is there, now what will be my beta formula? Covariance of X and Y divided by standard deviation of X square, because market is X in this. Now, I calculated, I am given with this data, I got X bar and Y bar. Now, I need small x, because to get covariance, what is my formula for covariance? Summation xy divided by n. So, for that I need small x, and for that I need small y also. Clear? Then for the beta formula, what is it? We need standard deviation of the market square. So, we need x square also. Clear? Y square actually could have been ignored. Stock we could have ignored also. So, you find this full table. This you know. X is x minus x bar, y is y minus y bar, x square, xy. Everything we have learned in statistics. We have the data ready with us. This is our x square. So, what I will do? Variance of x will be 12.67 divided by 3. Because standard deviation formula is square root of summation x square by n. If I don't do the square root, I'll get what variance I'll get. So, this is 4.22. 12.67 divided by 3, you will get 4.22. And y square is 8 divided by 3, that will get 2.67. Clear till here? Okay. Now, standard deviation, you can get the square root and get the standard deviation. Now, covariance of xy. See covariance of xy, what will I do? Summation xy divided by n. Summation xy is 10. 10 divided by 3 is 3.33. Clear? Correlation also I'll put. Correlation also I'll get the formula. What is the formula for correlation? Covariance of xy divided by sigma standard deviation x into standard deviation y. Correct? Now, covariance we got over here 3.33 divided by standard deviation is 2.06 and 1.63. You got correlation as 0.99. 0.99 correlation means it's almost a perfect positive correlation. Perfect positive correlation. Revision of what we have already done. Perfect positive correlation will teach us what? Perfect positive correlation tells us what? That if stock market goes in one direction, stock also will go in that direction only, but not same percentage and all. Variance you have to see. Clear? So 0.99. Now you see what we have to calculate. Beta, right? First formula for beta, you tell me. Covariance of stock and market, that is 3.33 divided by variance of market. What is the variance of market? 4.22. X is market in this 4.22. So 3.33 divided by 4.22, you are getting 0.79. Clear? That is your first formula for beta. One more formula for beta we had. What is that? Correlation. Correlation is how much? 0.99 into standard deviation of stock. Standard deviation of stock is 1.63 divided by standard deviation of market, that is 2.06. So 1.63 divided by 2.06 into 0.99. You are getting how much? 0.78. Same thing was the beta that time also. See this. 0.78, 0.79, that's fine because of our change in this thing. Okay, 0.79 and 0.78 you will get. Is this clear here, beta? There is one more methodology actually to calculate beta, which is not that much preferred in exams. The formula is that summation xy minus n into x bar y bar divided by summation x square minus n into x bar square. Okay, just for teaching the concept I'm going to teach that. Otherwise, apply the other two only, which is more logical. Because this is not giving you accuracy, it's giving you 0.81. But now, summation xy, x into y, we have already created the table and we got 10 here. Summation xy is 10 minus n was how much? How many numbers we had? 3 numbers we had. See, 1, 2, 3, 3 data sets. So 3 into x bar into y bar. X bar was 12.33, y bar was 10. You fit that. Denominator is summation x square, not standard deviation all. Summation x square. Summation x square was how much? Summation x square, we got 12.67. So 12.67 minus n into n was 3 into x bar square. X bar was how much? 12.33. 12.33 into 12.33. When you do this, no, you will get 0.81, which will be a very close enough answer to the real beta. But always for beta, you apply only two formulas. Covariance of X and market divided by standard deviation, variance of market. Beta is equal to correlation into standard deviation of stock divided by standard deviation of market. Okay. Note, the above formula can't be applied on data based on probabilities. See, if this is the formula, you can't apply on data based on probabilities, because you will have to get X, summation XY is not there only in probability. Directly you get the covariance. Okay, that should be it with that particular example. We'll take one more example. Okay, I'm keeping this example on the screen. Oh wait, this is about systematic risk and unsystematic risk, which we have not yet studied. So after we finish that decision of beta, then one more thing that I have to discuss is portfolio beta. Individual beta we found out, no, portfolio beta. Now in my portfolio I have stock X, Y and Z, and all these three I know the betas. I know the weightage of my portfolio also. Nothing but beta of portfolio is weighted average beta of individual securities. Individual security you will apply the effort and calculate the beta. Then the weightage of the portfolio. See how you got portfolio return? Weighted average return. Okay, so here you are getting beta of the portfolio also as the weighted average beta. So if I tell X, Y and Z, three stocks are there, and X stock is having beta of 1.2, Y stock is having beta of 1.5, Z stock is having beta of 0.8. How did I get this for individual stocks? How did I get? I used my formula covariance of XY divided by standard variance of X, or I used the formula correlation into sigma Y by sigma X, or standard deviation Y by standard deviation X. I used that and I got it for individual stocks. Now what I should do? I need to know the weightage of these stocks in my portfolio. Let's say it is 0.5, 0.3 and 0.2. Now I'll get the beta of the portfolio. 1.2 into 0.5 and 1.5 into 0.3, 0.8 into 0.2. How much are you getting? 1.21. This is how you get the beta of the portfolio. Is this clear till here? Weights are latest market value weights. Beta, now see, listen to this. Fun fact. When we were calculating the weighted average return, when you were calculating return of the portfolio, you were also taking market value weights, but you were taking market value weight at the beginning of the year. Why you are telling market value weight at the beginning of the year? Because you are telling from there I have generated this return. But when you are calculating the beta, you will still take weightage of the weightage will be taken as market values only. But market values will be latest market value weights, current market value weights. Why? Because we are telling sensitivity to market today. I don't want sensitivity which was there at the starting of the year. Is this clear? Yes, this is your discussion of beta. After this, you have something called as characteristic line, line of best fit, regression line, and then we have to go into total risk. This we will discuss in our next session. Okay. So till here, whatever we have done, please revise today. Okay, and we'll meet in the next class. From that, after this we have to learn about systematic risk calculation, unsystematic risk calculation, and also some topics like portfolio rebalancing. I feel that it's not proper. I'll take from here, put here. All that we'll discuss in the next class. Yes, that's it, guys. See you. Bye bye.